Stop being the bank's favorite customer and start being their biggest threat. The 1% uses loans to build empires while you use them to survive. Are you ready to flip the script and finally make the system work for you? Let me tell you something they don't teach you in school. Most people think debt is the devil. They think loans are traps. They think borrowing money means you're broke, desperate, or stupid. That's what they want you to think. Because while you're scared of debt, the wealthy are using it to get richer. While you're paying cash for everything, they're buying whole apartment buildings with other people's money. While you're saving up for years, they're leveraging their way into millions. Here's the truth. Debt is not the trap. Ignorance is. This audiobook is going to completely flip your script. You're going to learn how the rich use loans, how to make the bank work for you instead of against you, and how to use strategic leverage to build wealth they told you was impossible. This ain't about reckless borrowing. This is about playing the game the way it was designed to be played. You ready to learn how to cheat the system? Let's get into it. We will start from Chapter 1, which is The Lie You Were Sold. Why they taught you to fear debt. Let me ask you something real. Who taught you that debt is evil? Was it your parents? Your teachers? The financial guru on TV telling you to cut up your credit cards? Was it that nagging voice in your head that says, if you can't afford it, you shouldn't buy it? I'm not here to tell you that reckless borrowing is smart. That's not the game. But I am here to tell you that everything you were taught about debt was designed to keep you small, to keep you scared, to keep you playing a game you can never win. Debt is not the trap. Ignorance is. Say that again. Debt is not the trap. Ignorance is. Let's keep it a buck for a second. Think about who benefits from you being terrified of borrowing money. Is it you? No. You're stuck saving for years, missing opportunities, watching prices go up while you wait to afford things. The people who benefit from your fear? Banks. Actually, no. Banks want you to borrow. Credit card companies? They'd love you to carry a balance. So who's pushing this debt is evil narrative? Look closer. The people who taught you to fear debt are usually the same people who never build anything. They're the ones stuck in the rat race. They're the ones who've been convinced that playing it safe is the only way. They pass that fear to you like a family heirloom nobody asked for. Meanwhile, the wealthy were taught a different lesson entirely. You have a choice. Keep believing the lies that keep you small, or open your eyes to how money actually works. That's the key. Let's break down who really profits from the system. Banks don't make money from people who pay cash. Think about it. When you pay cash for a house, the bank makes nothing. When you pay cash for a car, the bank makes nothing. When you swipe your debit card instead of credit, the bank makes next to nothing. Banks make money from lending, from interest, from fees, from people who borrow and pay back. The banking system is designed to facilitate borrowing. It's their entire business model. Credit card companies don't profit from people who pay in full. The rewards you get? They're paid for by the people carrying balances. The ones paying 18%, 22%, 29% interest. That's where the real money is. The system needs borrowers. It's built on them. So if the system needs borrowers, why are we taught to fear debt? Why are we told to avoid it at all costs? Because they don't want you to borrow smart. They want you to borrow dumb. They want you to borrow for things that lose value. Cars, clothes, vacations, consumer crap. They want you to carry high-interest balances that keep you in debt forever. That's the trap, not debt itself. Stupid debt. The wealthy were taught differently. They were taught that other people's money is a tool, a lever, a way to multiply their efforts. They don't fear debt. They respect it. They understand it. They use it strategically. Let me give you a real-world example. Two people want to buy a rental property. It costs $200,000. Person A says, I'll save up and pay cash. Takes them 10 years to save. By then, the property is $300,000. They start over. Person B says, I'll borrow the money. They put $40,000 down, get a loan for $160,000. They buy the property now. It appreciates. It cash flows. 10 years later, they own it free and clear, and they've been collecting rent the whole time. Same goal, same property, completely different outcome. One person feared debt and got nowhere. One person used it strategically and built wealth. That's the difference. Debt is not the trap. Ignorance is. Now, I'm not saying go max out your credit cards. That's not the move. I'm not saying borrow money to buy stuff you don't need. That's how you stay broke forever. I'm saying understand the tool. Learn how it works. Use it for things that put money in your pocket, not take it out. The wealthy know this. They borrow to buy assets. They borrow to start businesses. They borrow to acquire things that appreciate or produce income. They let other people's money do the heavy lifting while they collect the profits. Meanwhile, the middle class borrows to buy liabilities. Cars that lose value. Vacations that end. Stuff that depreciates. They pay high interest for things that make them look rich but keep them broke. Which one are you going to be? You have a choice. Stay scared of debt and watch opportunities pass you by. Or learn to use it strategically and build something real. That's the key. Let's talk about the psychology of this fear. Most people's fear of debt isn't rational. It's emotional. It comes from watching their parents struggle with credit card bills, from hearing horror stories about people who borrowed too much and lost everything, from a lifetime of messaging that says debt is dangerous. That fear is real. I'm not dismissing it. But fear without understanding is just paralysis. You need to move from fear to respect, from avoidance to strategy. Think of debt like fire. Fire can burn your house down. Fire can also heat your home, cook your food, power your civilization. The difference isn't fire, it's how you use it. Debt is the same. Used stupidly, it destroys you. Used strategically, it builds empires. Debt is not the trap. Ignorance is. Let me tell you about two guys I know. First guy, let's call him Tim. Tim is terrified of debt, pays cash for everything, drives a 15-year-old car, rents an apartment because he's scared of a mortgage, has $50,000 in savings, earning 0.5% interest. Tim is safe. He's also going nowhere. Inflation eats his savings. Opportunities pass him by. He'll work until he dies. Second guy, let's call him Marcus. Marcus understands debt. He bought a duplex with an FHA loan, 3.5% down. Lives in one side, rents the other. The rent covers most of his mortgage. He's building equity with other people's money. He took out a small business loan to start a side hustle that now makes him $2,000 a month. He has credit card debt, but it's 0% introductory, and he's investing the cash instead of paying it off. Marcus isn't reckless. He's strategic. He understands the spread. He knows that if he can borrow at 4% and make 8%, the difference is his. He's using debt as a lever, not a crutch. 10 years from now, Tim will still be renting, still be saving, still be scared. Marcus will own multiple properties, have a thriving business, and be well on his way to freedom. Same starting point, different relationship with debt, different outcome. It's not about avoiding debt. It's about using it intelligently. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to rethink what you were taught. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The belief audit. Sit down and write out every belief you have about debt. Where did it come from? Your parents? School? Media? Is it actually true? Or is it just fear passed down? Separate fact from inherited anxiety. Action 2. The education commitment. Commit to learning how debt actually works. Not from scared people. From people who use it successfully. Read about leverage. Study how the wealthy borrow. Understand the difference between good debt and bad debt. Action 3. The small start. You don't need to take out a huge loan tomorrow. Start small. If you have good credit, get a credit card with rewards. Use it for things you'd buy anyway. Pay it off every month. Get comfortable with the tool without paying interest. Action 4. The mindset shift. Say this out loud right now. Debt is a tool. Used wisely, it builds wealth. Used stupidly, it destroys. I choose to use it wisely. Say it until you believe it. Debt is not the trap. Ignorance is. This is the foundation. Everything else in this book builds on this truth. The wealthy don't fear debt. They respect it, understand it, and use it to multiply their efforts. You can do the same. Not by being reckless, by being smart, by understanding the game and playing it the way it was designed to be played. Now, with this lie exposed, we got to get clear on what kind of debt actually builds wealth and what kind keeps you broke. Because not all debt is created equal. Far from it. We need to understand good debt versus bad debt. Moving to Chapter 2, Good Debt versus Bad Debt, the rich person's definition. And look, if this chapter just flipped your script on everything you thought about debt, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared and ready to be smart. You're not just listening to an audiobook. You're unlearning the lies. Subscribe now. Let's get this money. For real. It's time for the Chapter 2, Good Debt versus Bad Debt, the rich person's definition. Let me ask you something straightforward. When you hear the word debt, what comes to mind? Is it the mortgage on a rental property that pays you every month? Or is it the credit card balance from a vacation you can't remember? If you can't tell the difference, you're not alone. Most people can't. They've been taught that all debt is the same, dangerous, scary, something to avoid. But that's like saying all fire is the same. It's not. Fire can burn your house down or cook your dinner. The difference isn't the fire. It's how you use it. Not all debt is created equal. Say that again. Not all debt is created equal. There's debt that makes you poorer every single month. And there's debt that makes you richer. There's debt that drains your future. And there's debt that builds it. The wealthy know this distinction in their bones. The rest of the world lumps it all together and stays confused. You have a choice. Keep treating all debt like it's the devil and miss out on wealth. Or learn the difference and start using the right kind to build your future. That's the key. Let's start with the kind of debt that's killing most people. The kind they don't even realize is a problem. Bad debt, ego debt, consumer debt. Call it what you want. It's borrowing for things that lose value. What are we talking about? Cars, clothes, vacations, the latest iPhone, dinner at expensive restaurants, furniture, electronics, anything that depreciates the second you buy it, anything that doesn't produce income, anything you buy to look good for people you don't even like. This is ego debt. You borrow to feel important, to keep up, to project an image. And every month, you pay interest on something that's worth less than when you bought it. The money flows out of your pocket and never comes back. Ever. Let's run the numbers so you can feel how stupid this is. You finance a $40,000 car at 6% for 60 months. Your payment is about $775 a month. Over 5 years, you'll pay $46,500 for a car that's now worth maybe $20,000. You've lost $26,500 and paid interest the whole time. And now you need another car. That's not a loan. That's a hole you're throwing money into. Same with credit card debt. You put a $5,000 vacation on a card at 18% interest. You pay the minimum each month. It'll take you 15 years to pay it off and cost you over $7,000 in interest. For a vacation you don't even remember. That's ego debt. It's borrowing to look rich while actually getting poorer. Ego debt keeps you poor. Acquisition debt makes you rich. Know the difference? Now let's talk about the other side. The kind of debt that builds empires. Good debt. Acquisition debt. Investment debt. This is borrowing for things that gain value or produce income. What are we talking about? Rental properties that cash flow. Business loans that fund growth. Money borrowed to buy dividend stocks. Education that actually increases your earning power. Real estate that appreciates. Anything that puts money in your pocket or grows in value over time. This is acquisition debt. You borrow to acquire assets. And those assets pay the debt back, plus profit. Let's run those numbers. You borrow $200,000 at 5% to buy a rental property. The rent brings in $2,000 a month. After mortgage, taxes, insurance, and maintenance, you've got $300 a month left over. That's cash flow. The property also appreciates 3% a year, another $6,000 in equity. You're making money in 2 ways while someone else pays down your debt. That's acquisition debt. That's leverage. That's how you build wealth. Same with a business loan. You borrow $50,000 to expand your business. The expansion brings in an extra $20,000 a year in profit. You pay the loan back in 3 years, and now you own a bigger business. The debt was the tool that got you there. This is what the wealthy understand. They don't see debt as a burden. They see it as a lever, a way to multiply their efforts, a tool to acquire things that pay them forever. It's not about avoiding debt. It's about what the debt buys. Let me give you a real-world comparison so you can feel the difference in your bones. 2 guys, same income, same age. Let's call them Ego Eddie and Asset Alex. Ego Eddie leases a BMW for $700 a month, buys clothes on credit, takes vacations he can't afford, eats out constantly. His debt payments are for things that are worth nothing the moment he uses them. His money flows out and disappears. He looks good on Instagram. His bank account is a disaster. Asset Alex has an old Honda, lives modestly, but he borrowed $250,000 to buy a duplex. Lives in one side, rents the other. His tenants pay most of his mortgage. He took out a small business loan to start a side hustle that now makes him $1,500 a month. He uses credit cards strategically, buys things he needs, pays them off, collects rewards. 10 years later, Ego Eddie has a stack of old car payments and nothing to show. Asset Alex owns multiple properties, a thriving business, and is halfway to financial freedom. Same borrowing, completely different outcomes. The difference wasn't the debt. It was what the debt bought. Ego debt keeps you poor. Acquisition debt makes you rich. Know the difference? Now, let's get real about the psychology here. Ego debt feels good in the moment. That new car smell, the vacation photos, the nice dinner. It's instant gratification. Your brain lights up with dopamine. You feel important. You feel successful. But that feeling fades. And the payments don't. You're left with debt and nothing real to show for it. Acquisition debt feels different. It feels like work. It feels like responsibility. There's no instant dopamine hit. You don't get to post a photo of your new rental property and watch the likes roll in. It's boring. It's slow. It's invisible. But over time, that boring debt builds something real. Something that pays you. Something that outlasts the dopamine hit. You have a choice. Chase the temporary high of ego debt and stay broke. Or embrace the boring power of acquisition debt and build wealth. That's the key. Let me give you a simple rule to live by. Before you borrow, ask one question. Will this thing I'm buying put money in my pocket or take money out? If it will put money in your pocket, a rental property, a business, an income-producing asset, consider it. Run the numbers. Make sure the math works. Then borrow. If it will take money out, a car, a vacation, a new TV, pay cash or don't buy it. Full stop. No exceptions. That one question will save you from decades of financial misery. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to borrow for assets. You also don't need anyone's permission to stop borrowing for crap. Let me give you your action plan for this chapter. Real talk. No fluff. Let's fight with United Kingdom. I was kidding. Action 1. The debt audit. Pull out all your statements. Every loan. Every credit card. Every payment. Next to each one, write down what you bought. Was it an asset that puts money in your pocket? Or was it ego debt that just drains you? Be honest. No excuses. Action 2. The ego debt elimination plan. Pick one ego debt and commit to killing it. The highest interest rate. The smallest balance. Doesn't matter. Just pick one and make a plan to eliminate it. No new ego debt. Ever. Action 3. The acquisition debt education. Start learning about assets you could acquire with debt. Rental properties. Small businesses. Dividend stocks. Notes. Find one asset class that interests you and study it for 30 days. Know it better than anyone. Action 4. The question tattoo. Mentally tattoo this question on your brain. Will this put money in my pocket or take it out? Ask it before every single purchase. Every time. Let it guide you. Ego debt keeps you poor. Acquisition debt makes you rich. Know the difference. This is the distinction that separates the wealthy from everyone else. Not income. Not intelligence. Just knowing what kind of debt to take and what kind to run from. The wealthy borrow for assets. The broke borrow for toys. Choose wisely. Now, with this distinction crystal clear, we got to talk about the only number that really matters when you're using debt. The spread. The gap between what you pay and what you make. That's where fortunes are built. Moving to chapter 3. The spread, the only number that matters. And look, if this chapter just made you realize you've been using debt all wrong, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done borrowing for crap and ready to borrow for wealth. You're not just listening to an audiobook. You're learning the game. Subscribe now. Let's get this money. For real. Moving on to the chapter 3. The spread, the only number that matters. Let me ask you something that might hurt your brain a little. What if I told you that the actual interest rate on a loan is almost irrelevant? That the only number that really matters is something else entirely? That the wealthy don't care what rate they pay, they care about what they make? Most people look at a loan and ask one question. What's the interest rate? They think that's the whole story. They think a lower rate is always better. They think paying less interest is the goal. That's amateur thinking. It's not about the rate. It's about the spread. Say that again. It's not about the rate. It's about the spread. Here's the math the wealthy use. It's simple enough that a child could understand it. But most adults never learn it because they're too busy being scared of debt. You borrow money at X%. You invest that money and earn Y%. The difference between Y and X. That's the spread. That's yours. That's profit on money that isn't even yours. Let me give you the formula so you can tattoo it on your brain. Spread is equals to return on investment minus cost of debt. If you borrow at 4% and invest at 8%, your spread is 4%. That 4% is pure profit. You didn't work for it. You didn't save for it. You just borrowed other people's money and put it to work better than they could. You have a choice. Keep obsessing over interest rates like a broke person, or start focusing on spread like someone who's actually building wealth. That's the key. Let's break down why this mindset shift changes everything. Most people see interest as a cost, something to minimize, something bad. They think the goal is to pay as little interest as possible, or better yet, pay no interest at all. The wealthy see interest differently. They see it as the price of admission, the cost of accessing capital they don't have, the fee for using other people's money to build their own fortune. If you can borrow at 5% and make 10%, that 5% cost is the best money you'll ever spend. It's not an expense, it's an investment. It's buying you access to returns you couldn't get on your own. That's the key. Let me give you a real-world example so you can feel this in your gut. Meet Sarah and Tom, who love Donald Trump. Both have $50,000 saved. Both want to build wealth. Sarah is afraid of debt. She keeps her $50,000 in the bank earning 1%. She saves for years to buy one rental property with cash. 10 years later, she owns one property free and clear. Good for her. Slow and steady. Tom understands spread. He uses his $50,000 as down payments on 5 properties. He borrows $250,000 per property at 5%. Each property cash flows 8% after expenses. That's a 3% spread on $250,000, $7, $500 per property per year. Tom's 5 properties generate $37,500 in annual cash flow from money that isn't his, plus appreciation, plus equity paydown, plus tax benefits. 10 years later, Tom owns 5 properties worth millions. Sarah has 1. Same starting point, same savings, completely different outcome. The difference wasn't their income. It wasn't their intelligence. It was understanding the spread. It's not about the rate. It's about the spread. Now, let's get specific about how this works in different scenarios. Real estate example. You find a rental property for $200,000. You put $40,000 down, 20%. You borrow $160,000 at 5%. After all expenses, mortgage, taxes, insurance, maintenance, property management, the property nets you $1,000 per month. That's $12,000 per year. $12,000 on your $40,000 investment is a 30% cash-on-cash return. But wait, you also have equity paydown and appreciation. The real return is even higher. You made 30% on your money while paying 5% on the bank's money. That spread is massive, and it's all yours. Business example. You borrow $50,000 at 6% to expand your business. The expansion brings in an extra $20,000 per year in profit. After paying the $3,000 in interest, you're up $17,000. That's a 34% return on borrowed money. Would you rather have no debt and no extra profit, or $50,000 in debt and $17,000 in additional annual income? The answer is obvious if you understand spread. Stock market example. You borrow against your portfolio at 3%, margin loan. You invest that money in dividend stocks yielding 5%. That 2% spread is free money. Plus the stocks might appreciate. Plus dividends grow over time. Is there risk? Yes, there's always risk. But the math is the math. It's not about the rate. It's about the spread. Now, let's address the elephant in the room. The fear. Most people hear borrow to invest, and their amygdala starts screaming. What if the investment goes down? What if you can't make the payments? What if you lose everything? Those are real concerns. They're not stupid, but they're also not reasons to avoid leverage entirely. They're reasons to be smart about it. Here's how the wealthy manage that risk. They buy assets that cash flow, not speculation, not hoping for appreciation. Real, monthly, positive cash flow. The asset pays the debt service itself. They leave margin for error. They don't borrow up to their eyeballs. They keep reserves. They stress test their numbers. If things go wrong, they can survive. They understand the asset class. They don't gamble on things they don't understand. They study. They learn. They know their numbers cold. They think long term. They don't panic when markets dip. They know that over decades, the spread works in their favor. You can do the same. You don't need to be a genius. You just need to understand the math and respect the risk. It's not about avoiding risk. It's about being paid for taking it. Let me give you a simple rule to live by. Only borrow when the spread is positive and certain enough. Positive means your expected return is higher than your cost. Certain enough means you've done your homework and the asset has a track record of producing income. If you can't find a positive spread, don't borrow. If you're not sure about the return, don't borrow. Wait. Learn. Find the right opportunity. But when you find it, don't be afraid. Use other people's money to multiply your results. That's the game. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to understand and use spread. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The spread calculator. Take out a piece of paper. Write down any debt you have or any debt you're considering. Next to it, write the interest rate. Then write down what return you could get by investing that money elsewhere. What's the spread? Is it positive? Negative? This one exercise will change how you see every loan. Action 2. The opportunity hunt. Start looking for opportunities where the spread works in your favor. Rental properties in your area. Small businesses for sale. Dividend stocks. Find one asset class where the returns consistently beat borrowing costs. Action 3. The math practice. Run the numbers on a hypothetical deal. Pick a property. Calculate the mortgage. Estimate the cash flow. What's your return on investment? What's the spread? Do this until the math becomes automatic. Action 4. The mindset shift. Say this out loud. Interest is not the enemy. Negative spread is the enemy. I will only borrow when the math works in my favor. Let that be your new truth. It's not about the rate. It's about the spread. This is the number that matters. Not the APR. Not the monthly payment. Not the total interest. The spread. The wealthy have known this for centuries. They borrow at 4% and make 8%. They borrow at 5% and make 10%. They borrow at 6% and make 12%. And over a lifetime, that spread compounds into fortunes. Now you know the secret. The question is, what will you do with it? Now, with spread burned into your brain, we got to talk about how to actually make the bank work for you. Because knowing the math is one thing. Getting the money is another. Moving to Chapter 4, how to make the bank work for you. And look, if this spread concept just rewired your brain, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared of numbers and ready to use them. You're not just listening to an audiobook. You're learning the math of wealth. Subscribe now. Let's get this money. For real. In Chapter 4, we will discover how to make the bank work for you. Let me tell you something that might surprise you. Banks are not your enemy. I know. You've heard the stories. Foreclosures, overdraft fees, predatory lending, banks screwing over the little guy. And yeah, that happens. But here's the thing. Banks are not moral actors. They're not good or bad. They're machines. And machines can be used. The bank is a vending machine. Put in the right credentials, collect your cash. Say that again. The bank is a vending machine. Put in the right credentials, collect your cash. A vending machine doesn't care if you're a good person. It doesn't care about your hopes and dreams. It doesn't care if you deserve a snack. It cares about one thing. Did you put in the right coins? If yes, it dispenses. If no, it doesn't. Banks are the same. They don't care about your story. They don't care about your potential. They care about your credit score, your income, your debt-to-income ratio, your assets. Put in the right numbers, and they dispense money. Put in the wrong numbers, and they don't. You have a choice. Keep seeing banks as enemies to be feared, or start seeing them as vending machines to be understood. That's the key. Let's break down how the machine actually works. Banks want to lend money. This is their business model. They take deposits at 0.5% and lend at 5%, 6%, 7%. The difference is their profit. They are in the business of saying yes to the right people. Banks don't make money from people who never borrow. They make money from people who borrow and pay back. They need borrowers the way a store needs customers. Without borrowers, they'd be out of business. Your job is to become the kind of borrower they compete for, the kind they want to say yes to, the kind they fight over. What does that look like? Strong credit. This is the first thing they look at. 740 or higher puts you in the elite category. You get the best rates, the best terms, the easiest approvals. Below 620, you're in subprime territory. Higher rates, more scrutiny, more denials. Credit score is just a number, but it's the number that opens the door. Fix your credit. Pay your bills on time. Keep your utilization low. Don't open too many accounts at once. It's not complicated, but it requires discipline. Low debt-to-income ratio. This is how much you owe compared to how much you make. Lenders want to see this under 36%, ideally under 30%. The lower, the better. It shows you have room to take on more debt without choking. If your DTI is high, pay stuff down. Don't take on new debt. Give yourself room to borrow when it matters. Stable income. Lenders love consistency. 2 years at the same job. Steady or increasing income. Tax returns that tell a boring, reliable story. They don't want drama. They want predictability. If you're self-employed, this is harder. You need to show consistent income over time. You need clean books. You need to pay taxes and show that income on your returns. Cash under the mattress doesn't count. Assets they can see. Money in the bank. Investments. Retirement accounts. Real estate. Lenders want to know you have reserves. If something goes wrong, you can cover the payments. The more assets you have, the safer you look. Become that person, and banks will throw money at you. Let me tell you about 2 different people. First, meet Kevin. Kevin has a credit score of 580. He's got 3 credit cards maxed out. He's late on payments. His debt-to-income is 50%. He works odd jobs, can't show 2 years of steady income. He has no savings. Kevin walks into a bank and asks for a loan. What happens? They laugh him out of the building. Not because they're mean, because the vending machine doesn't accept his coins. His credentials don't work. Kevin thinks banks are evil. Banks won't give him a chance. The system is rigged. He's not wrong about the result, but he's wrong about why. The machine is working exactly as designed. He just doesn't have the right inputs. Now meet Rachel. Rachel has a credit score of 780. She has 1 credit card she pays off every month. Her debt-to-income is 28%. She's been at the same job for 5 years, with steady raises. She has $50,000 in the bank and a retirement account with $100,000. Rachel walks into a bank. 3 banks. They compete for her business. One offers 5.5%. Another offers 5.25%. A third offers 5% and a bottle of wine. Rachel picks the best deal. She gets her loan. She builds her wealth. Same banks. Same system. Completely different experience. The difference wasn't the bank. It was the inputs. The bank is a vending machine. Put in the right credentials, collect your cash. Now, here's where it gets really interesting. The wealthy don't just walk into banks and apply. They build relationships. They position themselves so banks come to them. They know loan officers. They go to local banks and introduce themselves. They bring their financials. They talk about their plans. They become a person, not just an application. They understand what lenders want. They know that banks love deposits. So they move money into the bank before they apply for a loan. They know banks love low-risk borrowers, so they clean up their credit years in advance. They play the game. They don't beg. They don't plead. They present themselves as the kind of customer any bank would want. And then they let the banks compete. You can do this too. You don't need to be rich. You just need to understand the machine. Let me give you a real-world example. Marcus, who lives in the United States, wanted to buy his first rental property. He had good credit, but not much else. He went to a local credit union where he'd had an account for years. He sat down with a loan officer. He brought his tax returns, his credit report, his plans for the property. The loan officer got to know him, saw that he was serious, saw that he had a plan. They approved his loan even though he wasn't the perfect candidate on paper. Marcus didn't just apply online. He built a relationship. He became a person, not a number. The machine still worked, but he had someone on the inside helping him navigate it. It's not about who you know. It's about how you position yourself. Let's get practical about how you do this. Step 1. Know your numbers. Before you ever walk into a bank, know your credit score. Know your debt-to-income ratio. Know your income history. Know your assets. If you don't know these numbers, you're not ready to borrow. Step 2. Fix what's broken. If your credit is low, fix it. Pay down debt. Dispute errors. Build a history of on-time payments. This takes time. Start now. If your DTI is high, pay stuff off. Don't take on new debt. Give yourself room. If your income is unstable, work on stability. 2 years of consistent income is the gold standard. Step 3. Build relationships. Open accounts at local banks and credit unions. Talk to loan officers before you need a loan. Introduce yourself. Let them know you're a serious person with serious plans. When you're ready to borrow, you won't be a stranger. Step 4. Present yourself well. When you apply, bring everything. Tax returns, bank statements, proof of income, a written plan. Look like the kind of person any bank would want to lend to, because that's exactly what you are. Step 5. Let them compete. Don't take the first offer. Get quotes from multiple lenders. Let them know you're shopping. Banks will compete for your business if you're a good candidate. Use that leverage. The bank is a vending machine. Put in the right credentials, collect your cash. This is the mindset shift. Banks aren't evil. They're not your friends either. They're machines. Tools. Vending machines. You don't get mad at a vending machine when you don't have the right change. You either get the right change or you move on. Same with banks. Either become the kind of person they want to lend to, or accept that you're not ready yet. But don't blame the machine. Learn how it works. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to become the kind of borrower banks compete for. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. Pull your credit. Today, right now, get your credit score from all 3 bureaus. Annualcreditreport.com gives you free reports weekly now. Know where you stand. Action 2. Calculate your DTI. Add up all your monthly debt payments. Divide by your monthly gross income. That's your debt-to-income ratio. If it's over 36%, make a plan to lower it. Action 3. Open a relationship. This week, go to a local bank or credit union. Open an account if you don't have one. Talk to a loan officer. Introduce yourself. Start building the relationship before you need it. Action 4. The 3-year plan. If you're not where you need to be, make a 3-year plan. Credit repair, debt paydown, income stability, asset building. 3 years from now, you can be the kind of borrower banks fight over. Start today. The bank is a vending machine. Put in the right credentials, collect your cash. This is the truth. The wealthy don't beg for money. They position themselves so money flows to them. They understand the machine. They input the right credentials. They collect. Now you know how it works. The question is, will you do the work to become the person the machine serves? Now, with the bank demystified, we got to talk about something that scares most people but actually works in your favor. Something that makes your debt cheaper over time. Something called inflation. Moving to Chapter 5. Inflation, your silent ally. And look, if this chapter just showed you that banks are just machines waiting to be used, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared of the system and ready to use it. You're not just listening to an audiobook. You're learning to play the game. Subscribe now. Let's get this money. For real. Let's dive into Chapter 5, which is inflation, your silent ally. Let me tell you about something that terrifies most people but makes the wealthy quietly smile. Inflation. You hear about it on the news. Prices going up. Your dollar not buying what it used to. The cost of everything creeping higher. Most people panic. They complain. They feel like they're getting poorer. And they're right, if they're holding cash. But if they're holding debt? Different story entirely. Inflation erodes debt. Smart borrowers love it. Say that again. Inflation erodes debt. Smart borrowers love it. Here's something most people never learn. Inflation is actually good for borrowers. While everyone else is panicking about prices going up, smart money is quietly smiling because they understand something the masses don't. You borrow money today. You pay it back tomorrow with dollars that are worth less. That's the game. That's the hidden wealth transfer from savers to borrowers. Let me break it down so you can feel it in your bones. You borrow $300,000 today to buy a house. Fixed rate, 30 years, 4% interest. Over those 30 years, inflation does its thing. At 3% average inflation, the dollar loses about half its purchasing power over 20 years. By year 20, you're paying back that loan with dollars that are worth 40% less than the ones you borrowed. Meanwhile, the house. It's rising with inflation. Real assets go up when the money goes down. Your $300,000 house is now worth $600,000, $700,000, maybe more. You win on both sides. Your debt shrinks in real terms. Your asset grows in real terms. That's the magic. Inflation erodes debt. Smart borrowers love it. Now, let's look at the alternative. The person who's afraid of debt. The person who saves up and pays cash for everything. The person who keeps all their money in the bank. Inflation is their enemy. Every year, their cash buys less. Every year, they get poorer without doing anything wrong. They're playing defense while the game rewards offense. You have a choice. Be the saver watching your cash evaporate, or be the smart borrower letting inflation work for you. That's the key. Let me give you a real-world comparison. Two people, same age, same income. Let's call them Cash Carl and Debt Derek. Cash Carl is terrified of debt. He rents an apartment because he's scared of a mortgage. He saves $500 a month in a bank account earning 0.5% interest. After 10 years, he's got about $62,000. But inflation has eaten away at its value. His $62,000 buys what $50,000 bought a decade ago. He's been running in place. Debt Derek understands inflation. He buys a $300,000 house with 5% down, $15,000. His mortgage is $1,600 a month. 10 years later, inflation has done its work. His house is worth $400,000. His mortgage balance is down to about $235,000. He's got $165,000 in equity. His monthly payment feels smaller because his income has risen with inflation. Same 10 years. Completely different outcomes. Carl has $62,000 in shrinking cash. Derek has $165,000 in growing equity. And Derek's asset keeps going up while Carl's cash keeps going down. That's the power of using fixed-rate debt in an inflationary world. It's not about avoiding debt. It's about using inflation as your partner. Let's go deeper into the mechanics. When you take out a fixed-rate loan, you lock in today's dollars for the next 30 years. Your payment is fixed, but your income tends to rise over time. Inflation drives wages up. Your $1,600 mortgage payment in year 1 might feel like a lot. By year 10, it feels like less. By year 20, it feels like nothing. Meanwhile, the asset you bought keeps pace with inflation. Real estate, businesses, stocks, these things rise when the money falls. You're hedged. You're protected. You're actually benefiting from the very thing that's hurting the cash hoarders. This is why the wealthy love fixed-rate debt. They lock in low rates for decades and let inflation do the heavy lifting. They're not scared of rising prices. They welcome them. Let me give you a historical example. In 1970, you could buy a house for about $25,000. A 30-year mortgage at 7% would cost about $166 a month. Seemed like a lot at the time. Fast forward to 2000. That $166 payment is nothing. A cup of coffee costs more, but you're still paying $166. Meanwhile, that house is worth $200,000, $300,000, maybe more depending on location. The person who bought in 1970 didn't predict inflation. They just took out a fixed-rate loan and held on. Inflation did the rest. You can do the same thing today. Inflation erodes debt. Smart borrowers love it. Now, let's address the elephant in the room. What if inflation goes away? What if we have deflation, prices falling? Deflation is the nightmare for borrowers. Your debt stays the same while your income and assets fall. That's what happened in the Great Depression. It's brutal. But here's the thing. Modern economies are designed to avoid deflation at all costs. Central banks print money, lower rates, do whatever it takes to keep inflation going. Why? Because inflation makes debt easier to pay back. And our whole economy runs on debt. The odds are overwhelmingly in favor of inflation continuing over the long term. Not every year, but over decades? Yes, the trend is clear. The wealthy bet on that trend. They borrow long-term, fixed rate, and let time and inflation work in their favor. It's not about predicting the future. It's about positioning for the odds. Let me give you a simple rule to live by. If you're going to borrow fixed rate and borrow long-term. Variable rates might be cheaper today, but they can rise. Adjustable rate mortgages might look attractive, but they expose you to risk. Fixed rate locks in your payment for decades. That payment will feel smaller every year as inflation does its work. And borrow for assets that rise with inflation. Real estate, businesses, stocks, things that go up when money goes down. Don't borrow for things that lose value. That's the opposite of the strategy. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to understand and use inflation to your advantage. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The inflation calculator. Look up an inflation calculator online. Pick a year 20 or 30 years ago. See how much prices have risen. Feel how much the dollar has fallen. Internalize this trend. It's been happening for decades and will keep happening. Action 2. The fixed rate commitment. If you have debt with variable rates, consider refinancing to fixed. If you're taking on new debt, make it fixed rate. Lock in today's dollars for the long term. Action 3. The asset check. Look at your assets. Do they rise with inflation? Real estate, stocks, businesses, cash, bonds. Shift your portfolio toward things that benefit from inflation, not things that get crushed by it. Action 4. The mindset shift. Say this out loud. Inflation is not my enemy. It's my silent ally. It erodes my debt and lifts my assets. I welcome it. Let that sink in. Inflation erodes debt. Smart borrowers love it. This is the truth the wealthy know and the masses miss. While everyone's panicking about rising prices, the smart money is quietly smiling because their debt is shrinking and their assets are growing. You can be part of that smart money, not by being lucky, by understanding how the game works. Now, with inflation as your ally, we got to talk about the superpower that makes all of this possible. The thing that turns your little into a lot. The thing that multiplies your returns and accelerates your wealth. We need to understand leverage. Moving to Chapter 6, Leverage, the rich person's superpower. And look, if this inflation chapter just flipped your script on something you thought was scary, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being afraid and ready to be smart. You're not just listening to an audiobook. You're learning the hidden rules of wealth. Subscribe now. Let's get this money. For real. Chapter 6 is all about leverage, which is definitely the rich person's superpower. Let me tell you about the closest thing to a superpower in all of finance. It's not compound interest, though that's powerful. It's not tax strategy, though that helps. It's not even finding the perfect investment, though that matters. It's leverage. Using other people's money to multiply your returns. Turning your little bit into a whole lot. Moving the world with a lever long enough. Leverage turns your little into a lot. Use it wisely. Say that again. Leverage turns your little into a lot. Use it wisely. Here's the simple truth that separates the wealthy from everyone else. The wealthy use other people's money. They use bank money. They use investor money. They use partner money. They use any money they can get their hands on, as long as the math works. The rest of the world tries to do it all with their own savings. And they wonder why it takes forever. You have a choice. Go it alone with your own money and take decades to build anything. Or use leverage and multiply your results. That's the key. Let me show you the math so you can feel the difference in your gut. Scenario 1. No leverage. You save up $250,000 over 10 years. You buy one house for cash. It appreciates 5% in a year. You make $12,500. Your return is 5%. Not bad. But it took you a decade to save that money, and you only have one asset. Scenario 2. With leverage. You save $50,000 over 2 years. You use it as a 20% down payment on a $250,000 house. You borrow the other $200,000. The house appreciates 5% in a year, $12,500. But here's the magic. That $12,500 gain is on your $50,000 investment. $12,500 divided by $50,000 is a 25% return. Same house, same appreciation. But because you used leverage, your return is 5 times higher. That's leverage. That's the superpower. Leverage turns your little into a lot. Use it wisely. Now, let's take it further. With no leverage, you buy one house in 10 years. With leverage, you could buy one house every 2 years. Same savings rate, same effort. 5 houses in 10 years instead of one. And each of those houses is leveraging someone else's money. Each one is multiplying your returns. Each one is building equity, cash flow, and appreciation. 10 years later, the person who didn't use leverage has one house paid off. The person who used leverage has 5 houses, each with equity, each cash flowing, each working for them. Same starting point, same savings, completely different outcome. The difference is leverage. It's not about having more money. It's about using other people's. Let me give you a real-world example so you can see this in action. Meet Tom and Jerry. Not those Tom and Jerry. Different ones. Tom is afraid of debt. He saves $1,000 a month for 10 years. He ends up with $120,000 plus a little interest. He buys one rental property for $120,000 cash. It cash flows $500 a month. Good for Tom. Solid. Steady. Jerry understands leverage. He saves the same $1,000 a month for 2 years. He's got $24,000. He uses it as a down payment on a $120,000 property, 20% down. He borrows the rest. The property cash flows $400 a month after expenses. He keeps saving. 2 years later, he's got another $24,000. Buys another property, then another, then another. 10 years later, Tom has one property free and clear, making $500 a month. Jerry has 5 properties, each making $300 to $400 a month after mortgages. That's $1,500 to $2,000 a month in cash flow. Plus, he owns 5 times the equity. Plus, his properties are appreciating faster because he bought sooner. Same savings rate. Same 10 years. Jerry's net worth is 5 times Tom's. Not because he's smarter, because he used leverage. Leverage turns your little into a lot. Use it wisely. Now, let's talk about the different kinds of leverage you can use. Bank leverage. This is the most common. You put down 20%, the bank puts up 80%. You control 100% of the asset. The bank gets paid interest. You get all the upside. Investor leverage. You find someone with money who wants to invest but doesn't have time or expertise. You bring the deal, they bring the cash. You split the profits. Their money does the heavy lifting, your brain does the work. Seller financing. The person selling the property agrees to hold the loan. You pay them over time instead of a bank. This can mean little or no money down. Partnership leverage. You team up with other people who have skills, money, or time. Together, you do deals none of you could do alone. Hard money leverage. Short-term, higher interest loans for fix and flip deals. Expensive, but can be worth it for the right opportunity. The wealthy use all of these. They don't limit themselves to one kind of leverage. They use whatever tool fits the deal. Leverage turns your little into a lot. Use it wisely. Now, let's address the fear. Because I know what you're thinking. What if the market crashes? What if the property doesn't appreciate? What if I can't make the payments? Valid concerns. And the wealthy have answers. They buy cash flow, not speculation. If the property cash flows from day one, they don't need appreciation. The tenant pays the mortgage. The asset pays for itself. Appreciation is just gravy. They leave margin. They don't borrow up to their absolute max. They keep reserves. They stress test their numbers. If things go wrong, they can survive. They think long term. They know markets go up and down. Over decades, real assets rise. They don't panic at every dip. They understand the asset. They don't leverage things they don't understand. They study. They learn. They know their numbers cold. Leverage without margin is gambling. Leverage with margin is investing. Know the difference. It's not about avoiding risk. It's about managing it intelligently. Let me give you a simple rule to live by. Only leverage assets that cash flow or have a strong history of appreciation with income potential. Don't leverage speculation. Don't leverage things you don't understand. Don't leverage so much that one mistake wipes you out. But when you find a solid asset with good numbers, don't be afraid to use other people's money to multiply your returns. That's how wealth is built. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to use leverage wisely. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The leverage math. Take a piece of paper. Write down an asset you'd like to buy. A rental property. A business. Whatever. Run the numbers 2 ways, with cash and with leverage. See the difference. Let the math sink in. Action 2. The leverage education. Pick one type of leverage and study it for 30 days. Bank loans. Seller financing. Partnerships. Learn how it works. Learn the pros and cons, know it better than anyone. Action 3. The deal hunt. Start looking for actual deals where leverage makes sense. Properties that cash flow. Businesses that can be bought with financing. Don't buy yet. Just look. Train your eye. Action 4. The margin rule. Decide right now. You will never leverage so much that one mistake wipes you out. You will keep reserves. You will stress test your numbers. Leverage with margin, not with desperation. Leverage turns your little into a lot. Use it wisely. This is the superpower. This is how the wealthy build empires while everyone else is saving pennies. Not by being smarter, by using other people's money to multiply their own. Archimedes said it thousands of years ago. Give me a lever long enough and a place to stand, and I will move the world. Your lever is other people's money. Your place to stand is a solid asset with good numbers. Now go move something. Now, with leverage in your toolkit, we got to get crystal clear on what kind of assets you should be leveraging. Because leverage on the wrong thing is disaster. We need to talk about acquisition debt, borrowing for things that pay you. Moving to Chapter 7, Acquisition Debt, How to Borrow Your Way to Wealth. And look, if this leverage chapter just opened your eyes to what's possible, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done going it alone and ready to use other people's money. You're not just listening to an audiobook. You're learning to multiply. Subscribe now. Let's get this money. For real. Moving over to the Chapter 7, which is Acquisition Debt and How to Borrow Your Way to Wealth. Let me tell you about the only kind of debt that should ever make you excited. Not credit card debt. Not car loans. Not vacation financing. That stuff should make you sick to your stomach. I'm talking about acquisition debt. Borrowing to buy things that pay you. Assets that put money in your pocket every single month. Machines that work so you don't have to. Acquisition debt buys assets that pay themselves off. That's the whole game. Say that again. Acquisition debt buys assets that pay themselves off. That's the whole game. Here's the simple truth. When you borrow to buy something that produces income, the debt becomes irrelevant. The asset pays for itself. Your tenants pay your mortgage. Your business profits cover your loan. Your dividend stocks send you checks that exceed your interest payments. You're not carrying debt. The asset is carrying it. You're just collecting the difference. You have a choice. Keep borrowing for things that drain you and stay broke. Or start borrowing for things that pay you and build wealth. That's the key. Let's get specific about what acquisition debt looks like. Rental properties. This is the classic. You borrow money to buy a house, a duplex, an apartment building. Tenants pay rent. That rent covers your mortgage, taxes, insurance, maintenance, and hopefully leaves something left over. That leftover is cash flow. Your asset is paying for itself and putting money in your pocket. Dividend stocks. You can borrow against your portfolio, margin, to buy more dividend-paying stocks. If the dividends exceed your interest cost, you're making money on borrowed money. The stocks pay for themselves. Businesses. You borrow to start or buy a business. The business profits cover the loan payments and give you income. The business pays for itself. Equipment. You borrow to buy a piece of equipment, a truck, a machine, tools, that you rent out or use to generate income. The income covers the payment. The equipment pays for itself. Notes. You borrow to buy promissory notes or mortgages from other people. The payments you collect cover your borrowing costs and give you profit. The note pays for itself. Notes. You borrow to buy promissory notes or mortgages from other people. The payments you collect cover your borrowing costs and give you profit. The note pays for itself. Notice the pattern? Every single one of these involves the asset producing enough income to cover the debt. The asset does the work. You just set it up and collect. Acquisition debt buys assets that pay themselves off. That's the whole game. Let me give you a real-world example so you can see this in action. Meet Denise. Denise understands acquisition debt. She starts small. She finds a duplex in a decent neighborhood for $200,000. She puts $40,000 down, 20%, and borrows $160,000 at 5%. Her mortgage payment is about $860 a month. Taxes and insurance add another $300. Total monthly cost, $1,160. She rents one side for $1,000 and the other for $900. Total rent, $1,900 a month. After expenses, she's got $740 left over. That's cash flow. The tenants are paying her mortgage and putting money in her pocket. Denise didn't buy a liability. She bought a machine. A machine that prints $740 a month and builds equity at the same time. She takes that $740 and saves it. A year later, she's got almost $9,000. Combined with more savings from her job, she's ready for the next deal. Then another. Then another. 10 years later, Denise owns 8 rental properties. Each one cash flows. Each one is paid down by tenants. Each one has appreciated. She's not rich yet, but she's well on her way. And she did it by using acquisition debt. It's not about how much you borrow. It's about what the debt buys. Now, let's talk about the key metric, cash flow. The goal of acquisition debt is not just to own assets. It's to own assets that produce more income than they cost. Positive cash flow. Money left over after all expenses, including debt service. This is your margin of safety. This is what makes the debt sustainable. If the asset cash flows, you don't have to worry about market ups and downs. You don't have to stress about vacancies. The math works. Let's run the numbers on a bad acquisition debt deal so you can see the difference. Bad deal. You borrow $200,000 to buy a property that rents for $1,500 a month. Your mortgage, taxes, and insurance are $1,600. You're losing $100 a month before maintenance. One broken water heater, and you're in the red. That's not an asset. That's a headache with a loan attached. Good deal. You borrow $200,000 to buy a property that rents for $2,000 a month. Your costs are $1,400. You've got $600 cushion. Vacancies? Covered. Repairs? Covered. You sleep at night. The difference isn't the debt. It's the spread between income and cost. Acquisition debt buys assets that pay themselves off. That's the whole game. Now, let's talk about how you start. Because I know what some of you are thinking. This sounds great, but I don't have $40,000 for a down payment. I don't have the credit. I don't know where to start. Start small. Smaller than you think. Start with a duplex in a cheaper area. You don't need $1 million property. You need something that cash flows. Look in B and C neighborhoods. Look for motivated sellers. Look for fixer-uppers you can improve. Start with seller financing. Sometimes the person selling will hold the loan. You pay them over time instead of a bank. Less money down, easier qualification. Start with a partner. Find someone with money who needs your time and expertise. You bring the hustle, they bring the cash. Split the profits. Start with a small business. A lawn care business. A vending machine route. A pressure washing service. Borrow a few thousand to buy equipment, then use the income to pay it back and save for the next thing. Start with dividend stocks. Open a margin account. Borrow a small amount against your holdings to buy more dividend payers. Reinvest the dividends. Let it compound. The key is to start. One asset, one deal, one machine. Acquisition debt buys assets that pay themselves off. That's the whole game. Let me tell you about a guy named Marcus. Marcus started with nothing. No money, no credit, no connections. He got a job, saved $5,000. Found a beat-up duplex in a rough part of town for $150,000. The seller was motivated. Marcus convinced him to do seller financing. $10,000 down, $140,000 at 6%, paid over 20 years. Marcus moved into one side, rented the other. His total housing cost dropped to $400 a month. He saved faster. 2 years later, he had enough for another down payment. Bought another property, then another. 10 years later, Marcus owns 12 units. His tenants pay his mortgages. He works a regular job, but he doesn't need to. His assets cover his life. Marcus didn't start with money. He started with understanding. He understood that acquisition debt is a tool, a machine, a way to let other people's money build his wealth. You can do the same. It's not about being rich to start. It's about starting to get rich. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to use acquisition debt wisely. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The asset hunt. This week, find one asset in your area that could cash flow with debt. A duplex. A small business for sale. A piece of equipment. Just look. Get familiar with what's out there. Action 2. The numbers game. Run the numbers on that asset. What would it cost to buy? What would it rent for? What would your payments be? What's the cash flow? Practice the math until it's automatic. Action 3. The small start. If you can't buy a property yet, start smaller. A few shares of a dividend ETF. A piece of equipment you can rent out. A tiny side business. Start somewhere. Anywhere. Action 4. The reinvestment commitment. Promise yourself that any cash flow from your first asset will be reinvested. Not spent. Reinvested. This is how you stack. This is how you grow. Acquisition debt buys assets that pay themselves off. That's the whole game. This is the path. Not borrowing for crap. Borrowing for machines. Assets that work while you sleep. Things that pay themselves off and put money in your pocket. The wealthy have been doing this for centuries. They borrow to buy. They let the assets pay. They collect the difference. And over time, that difference compounds into fortunes. Now you know the game. The question is, will you play? Now, with acquisition debt in your toolkit, we got to talk about the dark side. The kind of debt that looks like acquisition debt, but isn't. The kind that keeps you broke while making you look rich. We need to expose ego debt. Moving to Chapter 8, Ego Debt, the Silent Killer. And look, if this chapter just showed you a whole new way to think about borrowing, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done borrowing for crap and ready to borrow for wealth. You're not just listening to an audiobook. You're learning to build machines. Subscribe now. Let's get this money. For real. Chapter 8 is about the ego debt, which is silent killer. Let me tell you about the most dangerous kind of debt there is. It's not the mortgage on your rental property. That's working for you. It's not the business loan that's funding your growth. That's building something. It's the debt you take on to look good, to feel important, to project an image. The leased BMW in the driveway. The financed boat you use twice a year. The credit card vacation you're still paying for long after the tan fades. The designer clothes that lose half their value the moment you wear them. This is ego debt. And it's the silent killer of wealth. Ego debt makes you look rich today and stay broke forever. Say that again. Ego debt makes you look rich today and stay broke forever. Here's the tragedy. Ego debt feels amazing in the moment. That new car smell, the way people look at you, the validation, the feeling of having made it. Your brain lights up with dopamine. You feel successful. You feel important. But that feeling fades. And the payments don't. Every month, money flows out of your account to pay for something that's worth less than when you bought it. You're paying interest to look good for people who don't actually care. And while you're bleeding cash on ego, the people who are actually building wealth are laughing all the way to the bank. You have a choice. Look rich today and stay broke forever. Or actually be rich and let your money work. That's the key. Let's break down the mechanics of ego debt so you can see it for the trap it is. Cars. This is the biggest one. The average new car payment in America is over $700 a month. $700. For something that loses 20% of its value the second you drive it off the lot. Over 5 years, you'll pay $42,000 for a car that's worth maybe $20,000 at the end. You've lost $22,000 plus all the interest. That's not transportation. That's a wealth incinerator. And for what? To look good at stoplights? To impress people you don't even know? To feel important for the 3 minutes it takes to drive to work? The wealthy don't do this. They drive sensible cars. They buy used. They keep them for a decade. They invest the difference. Watches and jewelry. A $10,000 watch doesn't keep time better than a $200 watch. It just signals that you spent $10,000 on a watch. And unless you're in circles where that matters, nobody cares. Meanwhile, that $10,000 could be working for you, generating income, building wealth. Boats and toys. The two happiest days of boat ownership are the day you buy it and the day you sell it. Boats sit unused 90% of the time. They cost money every single month: storage, maintenance, insurance, payments. They're holes in the water you throw money into. Vacations on credit. You deserve a break. Yes, you do. But you don't deserve to be paying for last year's vacation next year. If you can't afford it without debt, you can't afford it. Save up. Go later. Your future self will thank you. Clothes and accessories. Designer brands lose value the moment you buy them. They're not assets. They're expenses with a logo. Buy quality, buy classic, buy within your means. Nobody worth impressing cares about your label. Ego debt makes you look rich today and stay broke forever. Let me tell you about two different people. We'll call them Flash Frank and Quiet Quentin. Flash Frank leases a BMW for $800 a month. He's got a $500 monthly payment on a boat he uses 4 times a year. He puts vacations on credit cards and pays them off slowly. He's got a watch collection worth $15,000, all financed. His clothes are designer. His Instagram is fire. Frank looks rich. He feels rich. He's also drowning. His debt payments eat up 40% of his income. He has no savings, no investments, no assets. He's one missed paycheck from disaster. Frank is 45 years old and has nothing to show for 20 years of work but payments and stuff. Quiet Quentin drives a 10-year-old Honda. He buys his clothes at normal stores. He vacations within his means, pays cash, or stays home. He's got a paid-off house and 3 rental properties. His dividend portfolio throws off $2,000 a month. He could retire tomorrow if he wanted. Quentin doesn't look rich. He doesn't feel rich in the flashy sense. But he is rich. Actually rich. Not payment rich. Not stuff rich. Free rich. Frank and Quentin might have similar incomes. But Frank chose ego debt. Quentin chose assets. And their lives are completely different. It's not about what you look like. It's about what you own. Let's talk about the psychology behind ego debt. Why do we do this? Why do we borrow money to look good for people we don't even like? Because we're insecure. Because we want validation. Because we've been sold a story that stuff equals success. Because society measures worth by appearance, not by substance. The car in the driveway. The watch on your wrist. The brand on your clothes. These are supposed to signal that you've made it. That you're important. That you're worthy. But here's the truth that sets you free. Nobody cares as much as you think they do. People are too busy worrying about their own image to be truly impressed by yours. That guy at the stoplight, he's thinking about his own problems. That person at the party, they're worried about how they look. The validation you're seeking is an illusion. It doesn't exist. And even if it did, would it be worth the price? Would a few seconds of admiration be worth years of payments? Would an Instagram like be worth delaying your financial freedom? The wealthy figured this out long ago. They don't need external validation because they have internal validation. They know what they're building. They know their net worth. They don't need a car to tell the world they're successful. The wealthy don't flex with debt. They flex with assets. They drive old cars and own apartment buildings. They wear normal clothes and own businesses. They live below their means and let their money work. They've chosen substance over appearance. And over time, that choice compounds into real wealth. You can make that same choice. It's not about deprivation. It's about direction. You're not giving up things. You're redirecting your resources towards something bigger. You're not saying no to a nice car. You're saying yes to financial freedom. You're not missing out on status. You're opting into real wealth. Every dollar you don't waste on ego debt is a dollar you can invest in assets. Every payment you avoid is money that can work for you. Every year you resist the trap is a year closer to freedom. Let me give you a simple rule to live by. If it won't put money in your pocket, pay cash or don't buy it. That car won't put money in your pocket. Pay cash or drive what you have. That boat won't put money in your pocket. Rent one when you want it. That vacation won't put money in your pocket. Save up and go later. But that rental property might put money in your pocket. That business might put money in your pocket. That dividend stock will put money in your pocket. Borrow for those, never for ego. Ego debt makes you look rich today and stay broke forever. You are strong. You are intelligent. You are the master of your own world. You don't need a car to tell people who you are. You don't need a watch to prove your worth. You don't need stuff to feel important. Your worth comes from within. Your wealth comes from assets. Your freedom comes from choices. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The ego audit. Look at everything you own that is payments. Car, boat, furniture, electronics, clothes. Next to each one, ask, did I buy this to impress someone? Does this put money in my pocket? Is this worth the payments? Be brutally honest. Action 2. The sell-off. If you have ego debt dragging you down, consider selling. Get rid of the boat. Trade the expensive car for something sensible. Free up that payment and redirect it to assets. It'll hurt for a minute. Freedom lasts forever. Action 3. The payment redirect. Every dollar you free up from ego debt should go straight into assets. Dividend stocks. Savings for a rental. Your business. Don't let lifestyle creep eat it. Redirect it. Action 4. The identity shift. Say this out loud. I don't need stuff to prove my worth. I am building real wealth, not a fake image. I choose assets over ego. Say it until you believe it. Ego debt makes you look rich today and stay broke forever. This is the truth. The car in the driveway won't pay your bills. The watch on your wrist won't fund your retirement. The designer clothes won't set you free. Only assets do that. Only investments do that. Only the money you keep and put to work does that. Choose assets over ego. Choose freedom over flash. Choose real over fake. Now, with ego debt exposed, we got to talk about how to become the kind of person banks actually want to lend to. Because all this leverage talk means nothing if you can't get the loans. We need to talk about positioning yourself as the borrower banks compete for. Moving to Chapter 9. How to position yourself as the borrower banks compete for. And look, if this chapter just made you realize you've been bleeding money on ego, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done looking rich and ready to actually be rich. You're not just listening to an audiobook. You're choosing freedom. Subscribe now. Let's get this money. For real. In Chapter 9, we will decode how to position yourself as the borrower banks compete for. Let me tell you something that might change how you see the entire banking system. Banks don't lend to everyone equally. They have favorites. They have a list of people who get the best rates, the best terms, the most money, the easiest approvals. And then they have everyone else, who gets the leftovers, the high rates, the endless paperwork, the rejections. You want to be on the first list, not the second. Position yourself right, and banks will fight to lend you money. Say that again. Position yourself right, and banks will fight to lend you money. Here's the thing most people never figure out. Banks are not in the business of saying no. They're in the business of saying yes to the right people. Their whole model depends on lending money. They want to lend. They need to lend. They just need to lend to people who will pay them back. Your job is to become that person. To become so obviously creditworthy that banks compete for your business. To make yourself so attractive that they offer you better rates, better terms, more money, just to get you to borrow from them instead of the other guy. You have a choice. Stay in the second tier, getting rejected, or overpaying. Or position yourself in the first tier and let banks fight over you. That's the key. Let's break down exactly what banks want. This isn't a mystery. It's not hidden. It's a checklist. And if you check the boxes, you win. What banks want? The checklist. Number 1. Good credit. This is the gatekeeper. Below 620, you're in subprime territory. High rates, tough approvals, lots of scrutiny. 660 to 720 is okay. You'll get approved, but not the best terms. 740 plus is the sweet spot. That's where the magic happens. The best rates, the easiest approvals, the most money. Credit score is just a number, but it's the number that opens the door. Pay your bills on time. Keep your credit utilization low. Don't open too many accounts at once. Dispute errors on your report. Do these things consistently, and your score will rise. Number 2. Low debt-to-income ratio. This is how much you owe compared to how much you make. Add up all your monthly debt payments, credit cards, car loans, student loans, mortgages. Divide by your monthly gross income. Lenders want to see this under 36%. Under 30% is even better. If your DTI is high, you look risky. You don't have room for more debt. If it's low, you look like you can handle more. Simple. Pay down debt. Don't take on new consumer debt. Keep your obligations low. This one number makes a huge difference. Number 3. Stable income. Lenders love boring. 2 years at the same job. Steady or increasing income. Tax returns that tell a consistent story. They don't want drama. They don't want surprises. They want predictability. If you're self-employed, this is harder but not impossible. You need to show consistent income over time. You need clean books. You need to pay taxes and show that income on your returns. Cash under the mattress doesn't count. Number 4. Assets they can see. Money in the bank. Investments. Retirement accounts. Real estate. Lenders want to know you have reserves. If something goes wrong, a vacancy, a repair, a job loss, you can cover the payments. The more assets you have, the safer you look. Keep money in the bank. Build your savings. Show them you're not living on the edge. Number 5. Tax returns that tell a good story. This is where a lot of self-employed people mess up. They write off everything to lower their taxes. Great for tax savings. Terrible for getting loans. Lenders look at your taxable income, not your cash flow. If your tax return shows you made $30,000, they don't care that you actually made $60,000 in cash. You have to decide. Pay less in taxes now and have trouble borrowing, or pay more in taxes and have access to cheap money. The wealthy often choose the latter because cheap money makes them more in the long run. Position yourself right, and banks will fight to lend you money. Let me tell you about 2 people. We'll call them Invisible Ian and Preferred Paul. Invisible Ian has a credit score of 620. He's got credit card debt, a car loan, and student loans. His DTI is 45%. He's been at his job for 8 months. He has $2,000 in the bank. His tax returns are a mess because he does side work for cash. Ian walks into a bank. They run his numbers. They say no, or they offer a high rate with crazy terms. Ian thinks banks are evil. He's not wrong about the result. He's wrong about why. Preferred Paul has a credit score of 780. He has one credit card he pays off every month. His DTI is 28%. He's been at his job for 5 years. He has $50,000 in the bank and a retirement account with $100,000. His tax returns show steady, solid income. Paul walks into a bank. They run his numbers. They smile. They offer him their best rate. He goes to another bank. They offer something even better. He goes back to the first bank and asks if they can match it. They do. Paul gets the loan he wants, at the rate he wants, with terms he wants. Not because he's lucky, because he positioned himself. Same banking system. Completely different experience. The difference wasn't the banks. It was the inputs. It's not about who you know. It's about how you look on paper. Now, let's talk about the next level, relationships. Because once you have the numbers, relationships take you to the next level. Build relationships with bankers. Don't just apply online. Go to local banks and credit unions. Talk to loan officers. Introduce yourself. Tell them what you're doing. Let them know you're serious. When you have a relationship, things happen. Loan officers remember you. They give you advice. They let you know about programs you didn't know existed. They work harder to make your loan happen because they know you. The best deals often don't hit the internet. They happen between people who know each other. A loan officer gets a call about a property before it's listed. A banker knows a program that fits your situation. A relationship gets you in the door when others are waiting. Go to local banks. Big national banks are fine, but local banks and credit unions often have more flexibility. They know the local market. They can make decisions faster. They care about relationships. Be a good customer. If you want them to lend to you, be the kind of customer they want. Keep deposits there. Be professional. Communicate clearly. Be easy to work with. Ask for advice. Loan officers know what they're looking for. Ask them, what would make me a stronger borrower? What should I work on? They'll tell you. Then do it. Position yourself right, and banks will fight to lend you money. Let me give you a real-world example. Marcus wanted to buy his first rental property. His numbers were good, but not great. Credit 720, DTI 35%, 2 years at his job, $15,000 saved. He could have applied online and maybe gotten approved. Instead, he went to 3 local banks. He sat down with loan officers. He brought his numbers. He told them his plan. One loan officer said, "Your DTI is a little high. If you pay off that car loan, you'll be in a much stronger position." Marcus paid off the car loan. Came back 3 months later. Approved. Another loan officer said, "We have a first-time homebuyer program you might qualify for. Lower rate, lower down payment." Marcus didn't know it existed. He got the loan. Marcus didn't just get a loan. He got better terms than he would have online. He got advice that made him a stronger borrower. He built relationships that will help him for years. That's the power of positioning. It's not about luck. It's about preparation meeting opportunity. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to become the kind of borrower banks compete for. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. Pull your credit. Today. Right now. Get your credit score from all 3 bureaus. Annualcreditreport.com gives you free reports weekly. Know where you stand. If it's below 740, make a plan to raise it. Action 2. Calculate your DTI. Add up all your monthly debt payments. Divide by your monthly gross income. If it's over 36%, make a plan to lower it. Pay down debt. Don't take on new consumer debt. Action 3. Build your reserves. Open a savings account if you don't have one. Start putting money away every month. Even $100 a month adds up. Banks want to see assets. Give them what they want. Action 4. Start building relationships. This week, go to a local bank or credit union. Open an account if you don't have one. Talk to a loan officer. Introduce yourself. Tell them you're building your financial life and want to understand what they look for. Start the relationship before you need it. Action 5. The 3-year plan. If you're not where you need to be, make a 3-year plan. Credit repair. Debt paydown. Income stability. Asset building. 3 years from now, you can be the kind of borrower banks compete for. Start today. Position yourself right, and banks will fight to lend you money. This is the truth. Banks are not enemies. They're machines. And machines respond to inputs. Give them the right inputs. Good credit, low DTI, stable income, visible assets, and they'll dispense money. The wealthy know this. They position themselves. They build their profiles. They cultivate relationships. And then they let banks compete for the privilege of lending to them. You can do the same. Not by being lucky, by being prepared, by being disciplined, by playing the game the way it's meant to be played. Now, with your positioning locked in, we got to talk about one of the most powerful tools in the borrower's toolkit: the art of refinancing, unlocking trapped equity, and putting it back to work. Moving to Chapter 10, the art of the refinance, unlocking trapped equity. And look, if this chapter just showed you how to become the kind of borrower banks actually want, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being ignored and ready to be fought over. You're not just listening to an audiobook. You're positioning yourself for wealth. Subscribe now. Let's get this money. For real. Our next chapter, Chapter 10, unveils when to hold debt and when to eliminate it. Let me ask you something that trips up almost everyone. When should you keep debt? When should you pay it off? Is there a right answer? A formula? A rule that works for everyone? The answer is both simpler and more complicated than you think. It involves math, and it involves psychology. And if you ignore either one, you'll make the wrong choice. Hold good debt forever. Kill bad debt on sight. Say that again. Hold good debt forever. Kill bad debt on sight. This is the rule. It's not complicated, but most people get it backwards. They pay off the cheap mortgage early while carrying credit card debt. They eliminate the loan on a rental property while financing a new car. They make decisions based on fear instead of math. You have a choice. Let fear drive your debt decisions and leave money on the table. Or use math and psychology to make the right call. That's the key. Let's break down when to keep debt. Keep debt when it's cheap. Low interest rates are your friend. If you're paying 3% on a mortgage and inflation is running at 3%, your real interest cost is zero. If you're earning 7% in the market, you're making money on borrowed funds. Cheap debt is a tool. Use it. Keep debt when it's acquisition debt. If the asset pays for itself, why would you pay it off? Your tenants are covering your mortgage. Your business profits are covering your loan. The asset is doing the work. Let it. Keep debt when you can reinvest at higher returns. This is the spread we talked about earlier. If you have a 4% mortgage and you can earn 8% in the market, every dollar you use to pay off the mortgage early costs you 4% in lost returns. That's stupid. Invest the cash instead. Keep debt when inflation is eating the principal. Remember Chapter 5? Inflation is your silent ally. It erodes the real value of your debt over time. You're paying back with cheaper dollars. Why rush to pay that off? Keep debt when you have the discipline to use it wisely. This is the psychological piece. Some people can't handle debt. They see a balance and panic. They make bad decisions. If that's you, maybe paying it off is worth the peace. But if you have the discipline, cheap acquisition debt is a wealth-building tool. Hold good debt forever. Kill bad debt on sight. Now let's talk about when to eliminate debt. Eliminate debt when it's high interest. Credit cards at 18%, 22%, 29%. This is emergency-level debt. Nothing you can invest in will reliably beat those returns. Paying off 22% credit card debt is the best investment you'll ever make. Kill it. Now, eliminate debt when it's ego debt. The car loan, the boat payment, the financed furniture. These aren't assets. They're liabilities with interest. They're draining you every month. Sell the stuff if you have to. Get rid of the payments. Free up that cash flow for things that actually build wealth. Eliminate debt when it keeps you up at night. This is the psychology piece, and it's more important than the math sometimes. If a debt is causing you stress, if you're losing sleep, if it's affecting your health or your relationships, pay it off. Peace of mind has value. Real value. If a paid-off house lets you sleep better, that peace is worth more than the investment returns you might get by keeping the mortgage. Sometimes the best return is peace of mind. Let me give you a real-world example. Two people, same situation. Let's call them Math Martha and Peace Paul. Math Martha has a $200,000 mortgage at 3.5%. She has $200,000 in the bank. The math says she should invest that money. The stock market averages 8 to 10% over time. She could earn $16,000 a year while paying $7,000 in interest. That's a $9,000 profit. Martha invests the money. She's up $9,000 a year. She sleeps fine. The math works. Peace Paul has the same mortgage, the same cash. But Paul lies awake at night thinking about that debt. He worries about losing his job. He worries about market crashes. He worries about what if. Paul pays off the mortgage. He loses the $9,000 a year in potential gains. But he sleeps like a baby. He feels free. He has peace. Who's right? Both. Martha made the mathematically optimal choice. Paul made the psychologically optimal choice. And for Paul, peace was worth more than the math. The key is knowing yourself. If you can handle the math, keep good debt. If you can't, pay it off. Neither is wrong. It's not about the perfect formula. It's about what works for you. Let's look at some common scenarios so you can apply this rule. Scenario 1, credit card debt. You have $10,000 on a card at 22%. Should you keep it or kill it? Kill it. Today, this is not a debate. Nothing you invest in will reliably beat 22%. Pay it off. Cut up the card. Never do that again. Scenario 2, car loan. You have a $30,000 car loan at 6%. The car is worth $25,000. Should you keep it or pay it off? This is ego debt. The car is depreciating. The interest is meaningful. If you have the cash, pay it off. If not, sell the car and buy something cheaper. Get rid of the payment. Scenario 3, rental property mortgage. You have a $150,000 mortgage at 4% on a property that cash flows $300 a month. Should you pay it off? Probably not. The tenant is paying the mortgage. You're getting cash flow. Inflation is eating the principal. Keep it. Let the asset work. Scenario 4, student loans. You have $50,000 in federal student loans at 3%. Should you pay them off early? Maybe, maybe not. If you have higher interest debt, kill that first. If you're maxing out retirement accounts and have cash left over, paying them off is fine. But don't rush if the rate is low and you can invest at higher returns. Scenario 5, the paid-off house dream. You have a 30-year mortgage at 3%. You could pay it off in 10 years by throwing extra money at it. Should you? Math says no. Invest the extra and you'll come out ahead. But if owning your home free and clear is your dream, if it gives you peace, do it. Just know the math. Hold good debt forever. Kill bad debt on sight. Let me tell you about a guy named Marcus. Marcus had a mix of debt. He had $5,000 on a credit card at 24%. He had a $25,000 car loan at 7%. He had a $200,000 mortgage on his rental property at 4%. He had $30,000 in student loans at 3.5%. Marcus was confused. Should he pay everything off? Should he keep it all? He learned the rule. First, he killed the credit card debt, transferred it to a 0% balance transfer card, paid it off in 6 months. Never carried a balance again. Next, he looked at the car. Ego debt. He sold it, bought a $10,000 used Honda with cash. No more car payment. Then he looked at the rental property. It cash flowed $400 a month. The tenant was paying the mortgage. Inflation was eating the principal. He kept it. Finally, the student loans. Low rate. He made minimum payments and invested the extra cash in the market. 10 years later, Marcus has 3 rental properties, a growing investment portfolio, and no consumer debt. He used the rule. He killed bad debt. He held good debt. And he built wealth. You can do the same. It's not about debt itself. It's about what kind of debt. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to make these decisions. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The debt inventory. List every debt you have. Write down the balance, the interest rate, and what it's for. Next to each one, label it. Good debt or bad debt. Acquisition or ego. Be honest. Action 2. The kill list. Pick your highest interest bad debt and make a plan to eliminate it. Credit cards first, then personal loans, then car loans, then everything else that's not building wealth. Kill them one by one. Action 3. The hold list. Look at your good debt. Low-rate mortgages on cash-flowing assets. Student loans at 3%. Business loans that are paying off. These you keep. Let them work. Don't rush to pay them off. Action 4. The peace check. Ask yourself honestly. Is any debt keeping you up at night? Even if the math says keep it, if it's stealing your peace, make a plan to eliminate it. Peace is worth more than spread. Hold good debt forever. Kill bad debt on sight. This is the rule. It's simple, but simple doesn't mean easy. It takes discipline to kill the bad debt. It takes wisdom to hold the good debt. It takes self-awareness to know when peace matters more than math. But you can do it. You have the framework. You have the rule. Now apply it. Now, with your debts sorted into good and bad, we got to talk about the ultimate goal. Building systems that outgrow your salary. using debt and leverage to create income machines that eventually make your job optional. Moving to Chapter 11, building systems that outgrow your salary. And look, if this chapter just gave you clarity on what to keep and what to kill, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being confused about debt and ready to master it. You're not just listening to an audiobook. You're learning to sort the good from the bad. Subscribe now. Let's get this money. For real. Next chapter, Chapter 11, is all about the psychology of leverage, staying sane when you owe millions. Let me tell you about the part of leverage nobody talks about. The math is easy. Borrow at 4%, make 8%, pocket the difference. Simple, elegant, beautiful on paper. But the psychology? That's different. That's harder. Because when you owe $500,000, $1 million, $5 million, the stakes feel different. The payments feel heavier. The what-ifs get louder. The fear creeps in. Leverage without reserves is just gambling with extra steps. Say that again. Leverage without reserves is just gambling with extra steps. Here's the truth the wealthy know that most people never learn. Leverage is a tool, but it's a tool that requires the right mindset. You can't be scared of the numbers. You can't personalize the debt. You can't let the zeros on the statement control your emotions. You have to stay sane when you owe millions. And that takes practice. That takes systems. That takes a fundamentally different relationship with debt. You have a choice. Let the weight of leverage crush your spirit and make you panic. Or develop the psychology to handle it and let it build your fortune. That's the key. Let's start with the first principle. Don't personalize the debt. The wealthy don't look at a $1 million loan and think, I owe $1 million. They think the property has a $1 million mortgage. They separate themselves from the debt. It's not personal. It's business. It's the asset's obligation, not theirs. This might sound like a small mental shift, but it's everything. When you personalize debt, every payment feels like a personal failure. Every interest charge feels like a personal loss. You carry the weight emotionally. When you depersonalize, you see it clearly. The debt is a tool. The asset is doing the work. You're just the architect. The wealthy don't focus on the debt. They focus on the asset. They look at the cash flow. Is the property paying for itself? Good. They look at the spread. Is the return higher than the cost? Good. They look at the long-term trend. Is inflation eating the principal? Good. The debt is just the background. The asset is the star. Let me give you a real-world example. Marcus owns 10 rental properties. Total debt, $2.5 million. To most people, that number would be terrifying. They'd lie awake at night thinking about $2.5 million. Marcus doesn't think about it that way. He thinks about his cash flow. Each property throws off $500 a month after expenses. That's $5,000 a month. $60,000 a year. He thinks about the equity. His properties are worth $3.5 million. His net worth is $1 million. He thinks about the tenants. They're paying down his mortgages every month. The debt is just the mechanism. The assets are the reality. That's the mindset. Leverage without reserves is just gambling with extra steps. Now, let's talk about the second principle. You need reserves. This is non-negotiable. If you're going to use leverage, you must have cash in the bank. Reserves. A safety net. Money that sits there, doing nothing, waiting for the inevitable. What inevitable? Vacancies. Repairs. Rate increases. Economic downturns. Life. If a rental goes vacant for 3 months, can you cover the payments? If the furnace dies, can you replace it? If rates rise and you have an adjustable loan, can you handle the increase? If the answer is no, you're not investing. You're gambling. You're hoping nothing goes wrong. And hope is not a strategy. Reserves are what turn leverage from gambling into investing. The wealthy know this. They don't lever up to their absolute max. They leave room. They keep 6 months, 12 months of payments in the bank. They have lines of credit they can draw on. They have backup plans. When something goes wrong, and something always goes wrong, they don't panic. They don't sell at the bottom. They don't lose sleep. They have reserves. They can wait it out. You need the same. Let's run the numbers. You buy a rental property for $200,000 with $40,000 down. Your monthly payment is $1,200. You should have at least $7,200 in reserves, 6 months of payments. Preferably $12,000, a full year. That money isn't earning much. It's sitting in a savings account. That's okay. It's not there to earn. It's there to protect. It's there to let you sleep at night. Leverage without reserves is just gambling with extra steps. Now, the third principle, stress test your numbers. Before you take on debt, run the worst-case scenarios. What if rates go up 2%? What if the property is vacant for 6 months? What if expenses are 20% higher than you estimated? What if the market drops 20%? If you can survive the worst case, you can handle the real case. If you can't, you're taking too much risk. The wealthy do this automatically. They don't assume everything will go perfectly. They assume things will go wrong. And they plan for it. Plan for the worst. Hope for the best. Leverage only what you can survive losing. Let me tell you about two investors. We'll call them Risky Rick and Reserve Rachel. Risky Rick finds a great deal. A duplex that cash flows $500 a month. He puts every penny he has into the down payment. No reserves left. He's counting on that $500 a month to cover his expenses. 6 months later, both tenants move out. The property is vacant. Rick has no cash. He can't make the payments. He's forced to sell at a loss. He loses his down payment, his deal, and his confidence. Rick blames real estate. He says it's too risky. The truth is, he wasn't investing. He was gambling without reserves. Reserve Rachel finds the same deal. She puts 20% down and keeps $15,000 in reserves. Same cash flow projections. 6 months later, both tenants move out. Rachel doesn't panic. She has reserves. She covers the payments for 3 months while she finds new tenants. The new tenants move in. The property keeps cash flowing. Rachel keeps building wealth. Same deal. Different reserves. Different outcome. It's not about the deal. It's about the margin you leave. Now, the fourth principle, think long-term. Leverage works over decades, not days. Markets go up and down. Interest rates fluctuate. Tenants come and go. But over 10, 20, 30 years, real assets rise. Debt gets paid down. Equity builds. If you're checking your portfolio every day, watching every market move, you'll drive yourself crazy. You'll make panic decisions. You'll sell at the wrong time. The wealthy don't do that. They set it and forget it. They check in quarterly, maybe annually. They trust the long-term trend. They know that time is on their side. Leverage is a marathon, not a sprint. Pace yourself. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to use leverage wisely and to stay sane while doing it. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The reserve calculation. Look at your current debts. If you have rental properties or business loans, calculate how much you'd need to cover 6 months of payments if all income stopped. That's your reserve target. Start building it. Action 2. The stress test. Take your biggest leveraged asset. Run the numbers with higher rates, lower income, higher expenses. Can you survive? If not, you need more reserves or less leverage. Action 3. The mindset shift. Say this out loud. The debt is not mine. It belongs to the asset. I am just the manager. My focus is on cash flow and long-term growth. Say it until you believe it. Action 4. The long-term commitment. Decide right now that you're playing the long game. Not days. Not months. Decades. You will not panic at every dip. You will trust the process. You will stay sane. Leverage without reserves is just gambling with extra steps. This is the truth. The math of leverage is beautiful, but the psychology is where most people fail. They let the zeros scare them. They let the payments stress them. They let the what-ifs paralyze them. Don't be that person. Be the person who understands that debt is just a tool, who keeps reserves so they never panic, who stress tests their numbers so they're ready for anything, who thinks in decades, not days. That person can handle millions in debt. That person can build real wealth. That person is you. Now, with your psychology fortified and your reserves in place, we got to talk about the ultimate goal. Building systems that outgrow your salary. Using debt and leverage to create income machines that eventually make your job optional. Moving to Chapter 12. Building systems that outgrow your salary. And look, if this chapter just showed you how to stay sane while using leverage, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared of big numbers and ready to handle them. You're not just listening to an audiobook. You're building the psychology of wealth. Subscribe now. Let's get this money. For real. It's time for the Chapter 12. Building systems that outgrow your salary. Let me tell you about the ceiling you didn't know you were hitting. Your salary has a limit. A hard, fixed, unbreakable limit. There are only 24 hours in a day. You can only work so many of them. You can only charge so much per hour. Even if you're a high earner, there's a cap on what one person can produce. That's the problem with trading time for money. The ceiling is always there. But asset systems? They have no ceiling. None. Zero. They can grow forever. Salary has limits. Systems don't. Borrow to build systems. Say that again. Salary has limits. Systems don't. Borrow to build systems. This is the final piece. This is where everything we've talked about comes together. The lies about debt. Good debt versus bad debt. The spread. Inflation. Leverage. Acquisition debt. Positioning yourself. The psychology of leverage. All of it leads here. To building systems that eventually outgrow your salary. To reaching the point where your money works harder than you do. To crossing from labor to ownership. You have a choice. Keep trading time for money and hit the ceiling. Or build systems that grow forever and leave the ceiling behind. That's the key. Let's talk about what systems actually are. A system is a machine that produces income without your direct labor. A rental property is a system. You buy it, you set it up, you rent it out. It produces income every month. You don't have to be there. You don't have to work for it. The system works. A business with employees and systems is a system. You build it, you hire people, you create processes. It runs without you. It produces income while you sleep. A portfolio of dividend stocks is a system. You buy them, you reinvest the dividends, they grow. They produce income every quarter without you lifting a finger. A digital product that sells on autopilot is a system. You create it once, it sells forever. No inventory, no shipping, no overhead. Just income. Each of these systems can be leveraged. Each one can be built using debt. Each one can be stacked on top of the others. Use debt to build systems. You borrow money to buy the first rental property. It cash flows. You use that cash flow plus more debt to buy the second, then the third, then the 10th. You borrow money to start the business. It grows. You use the profits plus more debt to expand, then to buy another business, then to invest in real estate. You borrow against your portfolio to buy more dividend stocks. The dividends pay the interest and buy more shares. The snowball grows. Debt is the fuel. Systems are the engine. Your salary is just the starter motor. Salary has limits. Systems don't. Borrow to build systems. Let me give you a real-world example of how this works. Meet Carlos. Carlos has a job, makes $60,000 a year. He saves $10,000. He uses it as a down payment on a small rental property. He borrows $40,000. The property cash flows $200 a month. Carlos keeps his job. He saves another $10,000. He buys another rental. Now he has 2 properties, cash flowing $400 a month. He keeps going, year after year. Some years he buys 1 property. Some years he buys 2. He uses debt every time. He keeps his job for the income and the credit. 10 years later, Carlos owns 12 rental properties. His systems produce $4,000 a month in cash flow, plus equity, plus appreciation, plus tax benefits. His job still pays $60,000, but his systems pay $48,000. He's almost there. 15 years later, his systems pay $72,000. More than his job. Carlos walks into his boss's office and quits. Not because he hates the job, because he doesn't need it. Carlos crossed the line. His systems outgrew his salary. He's free. That's the goal. That's the whole point. It's not about getting rich quick. It's about building systems that compound. Now, let's talk about how you stack systems. System stacking is the art of using one system to build the next. Your first rental property cash flows $200 a month. That $200 helps you save for the next down payment. It also builds equity, which you can refinance to pull cash out for the next deal. Your business profits help you buy real estate. Your real estate cash flow helps you start another business. Your dividend income helps you make larger down payments. Each system feeds the others. They multiply. They compound. They grow faster together than they ever could alone. This is how the wealthy think. They don't just build one system. They build ecosystems. Networks of income machines that support and amplify each other. You can't build this with just your salary. You need leverage. You need debt. You need other people's money. Let me give you a more advanced example. Meet Diana. Diana is a systems builder. She starts with a small digital product, an ebook about meal planning. Creates it in a month. Starts selling it for $10. makes $300 a month. That's System 1. She uses the $300 a month to pay for ads for the ebook. Sales grow. Now she's making $600 a month. System 1 grows. She creates a second digital product, a course about budgeting. Uses profits from the first to fund it. Launches it. Now she's making $1,000 a month total. She takes out a small business loan, $20,000 at 6%, to hire a virtual assistant and run more ads. Now her systems are making $2,000 a month. The loan payment is $200. The spread is positive. She uses the cash flow to buy a small rental property with a loan. Now she has real estate income too. 5 years later, Diana has multiple digital products, a small team, and 3 rental properties. Her systems produce $8,000 a month. Her job was optional years ago. She quit. Diana didn't get rich overnight. She built systems. She stacked them. She used debt to accelerate. And she crossed the line. Salary has limits. Systems don't. Borrow to build systems. Now, let's talk about the numbers you need to know. Your crossing number is the amount of monthly income your systems need to produce to replace your salary. If your job pays $5,000 a month after taxes, your crossing number is $5,000. When your systems produce that much, you're free. You don't need millions in the bank. You need enough systems producing enough income to cover your life. That might be $3,000 if you live simply. That might be $10,000 if you have high expenses. The number is yours, but you need to know it. Your stacking rate is how fast you can add new systems. If each rental property adds $300 a month, you need about 17 properties to replace a $5,000 salary. That sounds like a lot, but if you buy 1 a year, it's 17 years. If you buy 2 a year, it's 8.5 years. If you use leverage and partnerships, you can go faster. The math is simple. The execution is the hard part, but you don't have to do it alone. You don't have to do it with just your money. You have debt. You have leverage. You have other people's money. It's not about how fast you go. It's about never stopping. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to build systems that outgrow your salary. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. Calculate your crossing number. What would it take to replace your salary? Add up your monthly expenses. Be honest. That's your target. Write it down. Look at it every day. Action 2. Choose your first system. Pick one system to start. Rental property. Digital product. Small business. Dividend portfolio. Just one. Learn it. Start building it. Don't get distracted by shiny objects. Action 3. Use debt wisely. As you build your first system, look for opportunities to use debt to accelerate. A loan to buy equipment. A mortgage for a rental. A line of credit to fund growth. Start small. Get comfortable. Action 4. Stack. Don't stop. When your first system is running, start the second, then the third, then the fourth. Stack them. Let them feed each other. Never stop building. Salary has limits. Systems don't. Borrow to build systems. This is the final piece. This is where it all comes together. The lies about debt. The distinction between good and bad. The power of spread. The ally of inflation. The superpower of leverage. The wisdom of acquisition debt. The positioning that makes banks compete. The psychology that keeps you sane. All of it serves one purpose: building systems that outgrow your salary. Systems that make you free. Your salary has a ceiling. It always will. But systems? They have no limits. They can grow forever. They can compound forever. They can make you free forever. Now, with your systems building and your crossing number in sight, we got to talk about the final piece. The end game. What it all means when you finally get there. Moving to Chapter 13, the end game, financial sovereignty through strategic debt. And look, if this chapter just showed you what's possible when you build systems instead of just working for a paycheck, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done with the salary ceiling and ready to build something that grows forever. You're not just listening to an audiobook. You're building your freedom. Subscribe now. Let's get this money. For real. Moving over to the Chapter 13, the art of the refinance, unlocking trapped equity. Let me tell you about one of the most powerful moves in the wealthy person's playbook. You buy an asset. It appreciates. It builds equity. You now have value sitting there, trapped, doing nothing. It's like having money in a savings account that pays 0 interest. It's not working for you. It's just there. Most people leave it there. They feel good about the equity. They feel richer, but they never actually use it. The wealthy do something different. They refinance. They unlock that trapped equity and put it back to work. Equity is trapped wealth. Refinancing sets it free. Say that again. Equity is trapped wealth. Refinancing sets it free. Here's the simple truth. Equity in an asset is like a frozen asset. It's valuable, but it's not liquid. It's not working. It's not earning. It's just sitting there, waiting to be unleashed. Refinancing is the key that unlocks it. You get a new loan, pay off the old one, and pull cash out. That cash can buy more assets. Those assets build more equity, which you refinance again, and again, and again. This is the cycle. Buy, appreciate, refinance, repeat. Each cycle unlocks more capital. Each cycle builds more wealth. Each cycle accelerates your progress. You have a choice. Let your equity sit there like a lazy employee doing nothing. Or refinance it, put it to work, and build more. That's the key. Let's break down how refinancing actually works. The basics. You buy a property for $200,000. You put $40,000 down. You borrow $160,000. Over a few years, the property appreciates to $250,000. You've also paid down the mortgage a bit. Now you owe $150,000. Your equity is $100,000. That's $100,000 of value trapped in the property. You go to a bank. You apply for a new loan based on the current value, $250,000. They agree to lend you 75% of that, or $187,500. You use $150,000 to pay off your old loan. The remaining $37,500 comes to you as cash. Tax-free. No capital gains. Just cash. Now you have $37,500 to put toward your next deal. And you still own the property. You still have equity, about $62,500 left in it. The property still cash flows. The tenants still pay the mortgage. You've just recycled your gains. That's refinancing. That's how you turn trapped equity into working capital. Equity is trapped wealth. Refinancing sets it free. Let me give you a real-world example of how this compounds over time. Meet Teresa. Teresa buys her first rental property for $150,000. Puts $30,000 down. Borrows $120,000. 5 years later, the property is worth $200,000. She owes $110,000. Equity, $90,000. She refinances. Takes out a new loan for $160,000, 80% of current value. Pays off the old $110,000. Walks away with $50,000 cash. Tax-free. She uses that $50,000 as a down payment on 2 more properties, $25,000 each. Now she owns 3 properties instead of 1. 5 more years pass. All 3 appreciate. She refinances each one, pulling cash out again. Now she has $150,000 to work with. Buys 5 more properties. 15 years from her first purchase, Teresa owns 12 properties. She started with 1. She used refinancing to recycle her gains over and over. She never sold anything. She just kept unlocking equity and putting it back to work. That's the power. It's not about selling assets. It's about recycling equity. Now, let's talk about the key factors that make refinancing work. Appreciation. Your assets need to go up in value over time. This is why location matters. Why forced appreciation matters. Why buying right matters. You need equity to unlock. Debt paydown. Even without appreciation, your tenants are paying down your mortgage. Every payment builds equity. Every year you own the property, you owe less and own more. That equity can be refinanced too. Interest rates. Refinancing works best when rates are lower than your original loan. Lower rates mean lower payments, which means more cash flow, which means more room to borrow. But even if rates are similar, pulling cash out can still make sense if you have a use for it. Loan-to-value ratios. Banks will typically lend up to 70 to 80% of current value. The higher your equity, the more you can pull out. Keep your properties in good shape. Keep them rented. Keep your credit strong. This maximizes what you can access. The wealthy do this over and over. They don't sell their winners. They refinance them. They recycle the equity into more winners. They build portfolios that grow exponentially. Let me tell you about Marcus. Marcus owned a fourplex he'd bought for $300,000. 7 years later, It was worth $500,000. He owed $200,000. Equity, $300,000. He refinanced, took out a new loan for $400,000, paid off the old $200,000, walked away with $200,000 cash. He used that $200,000 as down payments on 2 more fourplexes. Each one cost $400,000. He put $100,000 down on each, borrowed the rest. Now Marcus owns 3 fourplexes instead of 1. His total units went from 4 to 12. His cash flow tripled. His equity tripled, all without selling anything. That's the art of the refinance. Equity is trapped wealth. Refinancing sets it free. Now, let's address the risks and the discipline required. Refinancing costs money. Closing costs, appraisal fees, loan origination fees. These can add up to thousands of dollars. You need to make sure the numbers work. If you're pulling out $50,000 and paying $3,000 in costs, that's 6%. Worth it if you have a use for the cash. Not worth it if you're just going to let it sit. You're taking on more debt. This is obvious, but important. When you refinance, you're resetting the clock. You're increasing your loan balance. You need to make sure the property still cash flows after the new loan. If it doesn't, you're creating a problem, not solving one. You need discipline. The cash you pull out should go to work. More assets, more investments, more systems. It should not go to cars, boats, or vacations. That's how you undo all your progress. The wealthy have this discipline. They see refinancing as a tool, not an excuse to spend. They recycle equity into more equity. They build, build, build. It's not about having cash. It's about putting cash to work. Let's talk about when not to refinance. Don't refinance if the property won't cash flow after the new loan. Run the numbers first. Make sure the rent covers the new payment with margin. Don't refinance if you have no use for the cash. If it's just going to sit in the bank earning nothing, you're better off leaving the equity where it is. Don't refinance if rates are significantly higher. If your current rate is 3% and new loans are 7%, the math probably doesn't work. Wait for better conditions. Don't refinance if you're planning to sell soon. The cost won't pay off. But when the conditions are right, when you have a use for the cash, when rates are favorable, refinance. Unlock that equity. Put it to work. Equity is trapped wealth. Refinancing sets it free. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to use refinancing as a wealth-building tool. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The equity audit. List every asset you own that has equity. Real estate, businesses, anything. Calculate your current equity and your loan-to-value ratio. Know what you're sitting on. Action 2. The refinance check. For each asset, ask, is now a good time to refinance? Have rates dropped? Has value increased? Do you have a use for the cash? Run the numbers. Action 3. The use plan. If you do refinance, have a plan for the cash before you get it. More assets, more systems, more income. Don't let it burn a hole in your pocket. Action 4. The long game. Commit to recycling your equity over and over. Buy, appreciate, refinance, repeat. Let each cycle build the next. This is how portfolios grow exponentially. Equity is trapped wealth. Refinancing sets it free. This is the art. This is how the wealthy turn one asset into many. How they recycle gains instead of cashing out. How they build portfolios that compound faster than anything else. You have equity. Maybe not much yet, but as you build, it will grow. And when it does, don't let it sit there trapped. Unlock it. Put it to work. Build more. Now, with refinancing in your toolkit, we got to talk about one final piece. The mistakes that trip people up. The pitfalls that turn leverage into disaster. Because knowing what to do is only half the game. Knowing what not to do is just as important. Moving to Chapter 14. Common pitfalls. How people blow it with leverage. And look, if this chapter just showed you how to unlock trapped equity and put it back to work, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done letting equity sit idle and ready to recycle it into wealth. You're not just listening to an audiobook. You're learning to compound your gains. Subscribe now. Let's get this money. For real. It's time for our second last chapter, Chapter 14. Common pitfalls. How people blow it with leverage. Let me tell you about the dark side of leverage. Leverage is powerful. It's the closest thing to a superpower in finance. It can turn your little into a lot. It can accelerate your wealth building by decades. It can make you free. But leverage is also dangerous. It can destroy fortunes just as fast as it builds them. It can turn a small mistake into a catastrophe. It can take everything you've built and wipe it out. Leverage multiplies gains and mistakes. Be smart. Say that again. Leverage multiplies gains and mistakes. Be smart. The wealthy know this. They respect leverage. They don't fear it, but they don't treat it lightly. They've seen people blow themselves up. They've learned from those mistakes. And they've built safeguards to make sure it doesn't happen to them. You need to do the same. Learn from others' failures so you don't have to experience them yourself. You have a choice. Be reckless with leverage and risk everything. Or be smart. Learn the pitfalls and build wealth safely. That's the key. Let's go through the biggest mistakes people make with leverage. Learn them. Remember them. Avoid them. Mistake 1. Borrowing too much. No margin for error. This is the classic. Someone gets excited. They find a deal. They stretch to buy it. They put every penny they have into the down payment. They borrow up to their absolute max. There's no room, no cushion, no margin. Then something goes wrong. A vacancy, a repair, a rate increase, a market dip, and they can't cover it. They're forced to sell at the worst time. They lose everything. The antidote: leave margin. Don't borrow up to your absolute max, keep reserves. Stress test your numbers. Assume things will go wrong. If you can't survive the worst case, don't do the deal. Mistake 2. Borrowing short-term for long-term assets. This is a killer. Someone uses a short-term loan, a HELOC, a construction loan, hard money, to buy a long-term asset. They plan to refinance later. But rates change, or values drop, or their credit changes, and they can't refinance. Now they're stuck with a short-term loan with high payments they can't afford. They have to sell. They lose. The antidote: match your debt to your asset. Long-term assets need long-term, fixed-rate debt. Don't gamble on being able to refinance later. Lock it in. Mistake 3. Using leverage for ego debt. This one hurts to watch. Someone borrows money to buy a car, a boat, a vacation home they can't afford. They tell themselves it's an investment. It's not. It's ego debt with extra zeros. The payments drain them every month. They can't save. They can't invest. They're trapped in the rat race, working to pay for stuff that's worth less every day. The antidote: only borrow for assets that pay you. If it doesn't put money in your pocket, pay cash or don't buy it. Period. Mistake 4. No reserves. Someone buys a rental property with every dime they have. No cash left. They're counting on the rent to cover everything. Then the tenant moves out, or the roof leaks, or the water heater dies, and they have nothing to fall back on. They're forced into debt, or they have to sell. Either way, they lose. The antidote: always have reserves. 6 months of expenses minimum. A year is better. Cash in the bank is not dead money. It's sleeping money, ready to wake up when you need it. Mistake 5. No plan. Someone borrows money because they can, because the bank approved them, because rates are low. They don't have a clear plan for what the money will do. They just want to invest. Then they panic. They don't know what to buy. They make bad decisions. They lose money. The antidote: have a plan before you borrow. Know exactly what you're going to buy. Know the numbers. Know the exit. Debt without a plan is just gambling. Mistake 6. Panic selling when markets dip. Markets go down. They always do. The amateur sees red numbers and panics. They sell at the bottom. They lock in their losses. They miss the recovery. The antidote: think long-term. Leverage works over decades, not days. Have reserves so you don't have to sell. Have patience. Markets recover. The wealthy know this. They buy when others panic. Leverage multiplies gains and mistakes. Be smart. Let me tell you about 2 investors. We'll call them Careful Carla and Reckless Rick. Reckless Rick finds a great deal. A fourplex for $400,000. He puts $40,000 down, every penny he has. Borrows $360,000 at a variable rate. No reserves. He's counting on the $1,000 a month cash flow to cover everything. 6 months later, 2 tenants move out. The variable rate goes up. His payment increases. He has no cash. He can't make the mortgage. He's forced to sell at a loss. He loses his $40,000 and his dream. Rick blames real estate, says it's too risky. The truth is, he wasn't investing. He was gambling with no margin. Careful Carla finds the same deal. She puts $40,000 down but keeps $20,000 in reserves. She gets a fixed-rate loan. She stress tests the numbers. What if vacancies? What if rates rise? She can survive. 6 months later, 2 tenants move out. Carla doesn't panic. She has reserves. She covers the payments for 3 months while she finds new tenants. The property keeps cash flowing. She keeps building wealth. Same deal. Different approach. Different outcome. It's not about the deal. It's about how you structure it. Now, let's talk about the antidotes in more detail. Conservative underwriting. When you run the numbers, be conservative. Use higher vacancy rates. Use higher expenses. Use lower rent growth. If the deal works with conservative numbers, it'll work in real life. If it only works with optimistic numbers, pass. Reserves. Cash in the bank is not sexy. It doesn't earn much. But it's the difference between sleeping well and panicking, between holding and selling, between winning and losing. Keep reserves. Long-term fixed rates. Variable rates might be lower today, but they can rise. Fixed rates give you certainty. You know your payment for 30 years. You can plan around that. Assets that cash flow. Don't buy speculation. Don't buy hoping for appreciation. Buy things that pay you every month. Cash flow is your margin of safety. Cash flow is what lets you wait out the dips. Patience. Leverage works over time. Not overnight. Not in a year. Over decades. Be patient. Don't panic at every dip. Don't chase every trend. Just keep building. Discipline. This is the umbrella over everything. Discipline to run the numbers. Discipline to keep reserves. Discipline to say no to bad deals. Discipline to hold when others panic. Discipline to keep going when it's boring. Leverage multiplies gains and mistakes. Be smart. Let me give you a simple rule to live by. Only borrow what you can survive losing. If a deal goes bad, can you cover the payments? Can you walk away without losing everything? If the answer is no, you're borrowing too much. The wealthy don't bet the farm. They bet amounts they can afford to lose. They keep the farm separate. They build slowly, steadily, safely. You need to do the same. It's not about how much you can borrow. It's about how much you can handle. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to use leverage, but you do need to use it wisely. Let me give you your action plan for this chapter. Real talk. No fluff. Action 1. The mistake audit. Look at your current or past use of debt. Have you made any of these mistakes? Borrowing too much? No reserves? Short-term for long-term? Ego debt. Be honest. Learn from yourself. Action 2. The stress test. Take your biggest leveraged asset. Run the worst-case scenarios. Vacancy. Rate increase. Expense spike. Can you survive? If not, you need more reserves or less debt. Action 3. The reserve rule. Commit to keeping 6 months of payments in cash for every leveraged asset. No exceptions. This is your safety net. Build it. Action 4. The long-term promise. Promise yourself you will not panic sell. You will not make decisions based on fear. You will think in decades, not days. Write it down. Mean it. Leverage multiplies gains and mistakes. Be smart. This is the truth. Leverage is a superpower. But superpowers come with responsibility. Use it wisely, and it will build your fortune. Use it recklessly, and it will destroy you. The wealthy know this. They've learned from the mistakes of others. They've built safeguards. They've cultivated discipline. Now you know too. Avoid the pitfalls. Keep reserves. Think long-term. Be smart. And let leverage work for you, not against you. Now, with the pitfalls mapped out, we have one final chapter. The endgame. What it all means when you finally master the game. Moving to Chapter 15. The endgame. Financial sovereignty through strategic debt. And look, if this chapter just saved you from making expensive mistakes, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done learning the hard way and ready to learn the smart way. You're not just listening to an audiobook. You're building wealth safely. Subscribe now. Let's get this money. For real. Moving to our final chapter, Chapter 15. The endgame. Financial sovereignty through strategic debt. Let me ask you something that cuts to the heart of everything. What is this all for? Not the money. Not the assets. Not the spread. Not the leverage. What's the point? Why go through all of this? Why learn to use debt strategically? Why build systems that outgrow your salary? Why master the psychology of leverage? It's not to be rich. It's not to flex on Instagram. It's not to impress people you don't even like. It's sovereignty. Control over your time. Control over your life. Control over your future. The ability to wake up and do whatever you want with your day. The power to say no to things that don't serve you. The freedom to say yes to what matters. Strategic debt isn't cheating. It's finally playing the game the right way. Say that again. Strategic debt isn't cheating. It's finally playing the game the right way. For too long, you were told that debt is bad, that borrowing is dangerous, that you should save up and pay cash for everything. That message kept you small. It kept you scared. It kept you on the sidelines while the wealthy built empires. Now you know the truth. Debt is a tool, a lever, a way to multiply your efforts. Used wisely, it's the fastest path to sovereignty. You have a choice. Keep playing by the old rules and stay stuck. Or learn the real rules and set yourself free. That's the key. Let's talk about what sovereignty actually looks like. Sovereignty is not needing a boss. Not that you'll never work again. Not that you'll never have a job. Just that you don't need one. You can walk away from any situation, any person, any job that doesn't serve you. Your assets have your back. Sovereignty is not needing to take crap. When someone disrespects you, you can leave. When a situation is toxic, you can exit. When people pressure you, you can say no. Not because you're rude, because you can afford to protect your peace. Sovereignty is not stressing about layoffs. The economy crashes, your company restructures, your industry disappears. It doesn't matter. Your assets keep paying. You might need to adjust, but you're not panicking. You're not one paycheck away from disaster. Sovereignty is spending time how you want. With your kids, with your parents, with your partner, on your hobbies, on your health, on nothing at all. Time is the only non-renewable resource. Sovereignty is having control over yours. Sovereignty is being able to give to causes you believe in, to people who need help, to your community, not because you have to, because you want to, because you can. This is the end game. This is what all the work is for. Strategic debt isn't cheating. It's finally playing the game the right way. Let me tell you about Marcus. You've heard about him throughout this book. Marcus is at the end of his journey now. Marcus started with nothing. No money, no credit, no connections. He got a job. He saved. He learned. He used debt strategically. First, a small rental property. Then another. Then a business loan for a side hustle. Then refinancing to pull equity out for more deals. Then more properties. Then more businesses. 20 years later, Marcus owns 15 rental properties and 2 businesses that run without him. His systems produce $15,000 a month. His expenses are $5,000. He's free. Marcus doesn't have a boss. He doesn't have to take crap. He doesn't stress about layoffs. He spends his time how he wants. He gives to causes he believes in. Marcus isn't rich in the flashy sense. He drives an old truck. He lives in a modest house. But he's sovereign. He owns his time. He owns his life. That's the end game, not the stuff. The freedom. It's not about what you have. It's about what you control. Now, let's talk about what it means to master the game. When you master strategic debt, you're not afraid of banks anymore. You understand them. They're vending machines. You put in the right credentials, they dispense cash. You don't fear them. You use them. When you master strategic debt, you're not afraid of debt itself. You know the difference between good debt and bad debt. You know how to use acquisition debt to build wealth. You know how to kill ego debt on sight. Debt is just a tool in your toolbox. When you master strategic debt, you're not afraid of the system. You understand how it works. You know that inflation is your ally. You know that leverage multiplies your returns. You know that refinancing unlocks trapped equity. You play the game instead of being played by it. The wealthy have been playing this game for centuries. They've used other people's money to build empires. They've used debt to acquire assets. They've used leverage to multiply returns. They've used refinancing to recycle equity. They've used the system to their advantage. Now you know the rules. Now you can play too. Not because you're special, because you learned, because you put in the work, because you stopped being scared and started being smart. Strategic debt isn't cheating. It's finally playing the game the right way. Let me give you a final example. Meet Diana. Diana is 35. She started 5 years ago with nothing. No savings, no credit, no clue. She got a job. She saved. She learned. She used a small loan to start a side business. She used credit cards strategically, bought inventory, paid them off, built credit. She bought her first rental property with an FHA loan, 3.5% down. 5 years later, Diana owns 3 rental properties, a thriving online business, and a portfolio of dividend stocks. Her systems produce $4,000 a month. Her job pays $3,500. She's almost there. Diana looks at her numbers. Another year or two, and her systems will outgrow her salary. She'll be free. She's 35. She has her whole life ahead of her. Diana isn't a genius. She's not lucky. She just learned the game and played it. You can be Diana. You can be Marcus. You can be anyone who decides to learn and act. It's not about where you start. It's about that you start. You are strong. You are intelligent. You are the master of your own world. You don't need anyone's permission to pursue sovereignty. Let me give you your final action plan. Real talk. No fluff. Action 1. The sovereignty vision. Spend 10 minutes imagining your ideal free day. Not a vacation, a regular day when you have complete control. Where are you? Who are you with? What are you doing? How does it feel? Let that vision pull you forward. Action 2. The crossing number. Calculate how much monthly income you need from your systems to be free. That's your crossing number. Write it down. Look at it every day. Action 3. The strategic debt commitment. Commit to using debt only for acquisition, never for ego. Commit to understanding spread, inflation, leverage, and refinancing. Commit to playing the game the right way. Action 4. The long game promise. Promise yourself you will keep building. Not for a year. Not for 5 years. For as long as it takes. You will not quit. You will not panic. You will not stop until you're free. Strategic debt isn't cheating. It's finally playing the game the right way. This is the end game. Not the money, the freedom, the sovereignty, the ability to live life on your own terms. The wealthy have known this for centuries. They've used debt strategically. They've built systems that outgrow salaries. They've achieved sovereignty. Now you know the rules. Now you can play too. Not by being lucky, by being smart, by being disciplined, by using the tools the wealthy have always used. Debt is not the enemy. Ignorance is. Fear is. Inaction is. You have the knowledge. You have the tools. You have the framework. Now go build your sovereignty. And look, if this audiobook just rewired how you see debt, leverage, and financial freedom, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared of the system and ready to use it. You're not just listening to a book. You're learning to play the game. Subscribe now. Let's get this freedom. For real. So here's the deal. Everything you were taught about debt was a lie. Designed to keep you small. Designed to keep you scared. Designed to keep you renting your life instead of owning it. Now you know the truth. Debt is not the trap. Ignorance is. Good debt buys assets that pay you. Bad debt buys toys that drain you. Spread is the only number that matters. Inflation is your silent ally. Leverage is your superpower. And the bank? The bank is just a vending machine waiting for you to put in the right credentials. You don't need to be rich to start. You just need to be smart. You just need to be disciplined. You just need to understand the game. The wealthy have been using other people's money for centuries. Now it's your turn. Go build. Go leverage. Go free. And look, if this audiobook just rewired how you see debt and leverage, do yourself a favor and hit subscribe. Every week, more real talk for the person who's done being scared of the system and ready to use it. You're not just listening to an audiobook. You're learning to play the game. Subscribe now. Let's get this money. For real.